Record.
እንደምን አደራችሁ። I would like to welcome Dr. Brooke Aye, Director General of the Capital Markets Authority. I also like to welcome the senior team members of the Capital Markets Authority and ESX who are present with us. I also like to welcome all of you from the financial institutions, from the business community on this important workshop that will be held between today and tomorrow for the entirety of the day with the topic of understanding credit risk ratings and a number of instruments that will be used in our country to fund some of our exciting projects. I am Fasil Gabrezadik. I work for FSD Ethiopia. I lead the capital markets team. We are coordinating with the Ethiopian Capital Markets Authority, with ESX, including with the United Nations Economic Commissions for Africa, to host this workshop with you all between today and tomorrow. I would like to thank Sonia Esobamji, who is the Chief Innovative Finance and Capital Markets of UNECA, for allowing us to host this workshop here in this beautiful facility. I would also like to introduce EK, or Ikechua, from Augusto and Company. He is the Regional Director for East Africa. He will be the one who will walk us through the entire 2 days of sessions. We'd like to make it as interactive as we possibly can. And most importantly, we'd like to walk away with a thorough understanding, key takeaways and action points on how we can move forward with this important session. Allow me to speak a little bit about FSD Ethiopia. We've been established for about 2 years. We have 3 pillars. One is access to finance, the capital markets, which I lead. We also have a pillar on the climate finance, which I also intend to lead it until we find someone to join us. There is a financial inclusion or digital finance, which is being led by Abel, my colleague, who is not here today. We are working on these pillars to support the financial ecosystem, to deepen it. Our engagement on the capital markets ecosystem involves supporting issuers, investors, and then the intermediaries. And one of the most important intermediaries, the unsung heroes, are the credit rating agencies. We're going to find a lot more interactive sessions from this, and I'll jump in whenever it's possible to enlighten the discussions. With that, there's a lot more Dr. Brooke would like to say, because fixed income securities are going to be much more important in the capital market ecosystem. It's pretty much like the backbone of what we call, the capital, the securities exchange and the listing and the trading it constitutes a significant portion compared to like equities. And nowadays, of course, equities is like declining in numbers in terms of listing. We expect fixed income is going to become so much more important. So debt issuers, corporate issuers, government, including treasuries, this would require a sort of rating. And the best that can be done is by African-born, African-led solutions. And that's why we have Augusto here to walk us through that process. So without further ado, I'll introduce Dr. Brooke. Thank you for coming to make an opening remark for us. And Dr. Brooke, please take it away.
Thanks so much, Fasil. ይሰማል? ጨርሻ ላይ ይሰማችኋል? Okay, perfect. እንደምን አደራችሁ? So, I mean, it's a great pleasure to be here with among all of you. Before I get into what I was instructed to talk about in terms of credit rating agency and how it would be an important pillar, as Fasil indicated, especially on the fixed income side, I just want to take a couple of minutes to kind of give you a briefing in terms of where we are. As you know, the Capital Market Authority has been established now for 14 months. We've been working hard to make sure that we launch the market this year in 2024. My colleagues at the exchange and ourselves have been trying to put in place all the necessary technological, legal, and human resource capacity so that the market becomes operational. We have started accepting applications for various intermediary services. Of course, one of it is capital market service providers by way of credit rating agencies. And I'm very happy to tell you, we've one of the first application that we received is for an investment advisory service from a very reputable international firm. So my colleagues are currently reviewing that. So if there are any, if any of you are interested in requesting a license, I will be very much happy to work with you to make sure either securities brokers, investment bank, and other activities. Also, what we understand is for our 30 strong banks and 18 insurance companies, all homegrown banking service providers, we would want them to be capital market service providers. We are at the very final stages of discussing with the National Bank of Ethiopia to make sure that our banks would find a way to be active in this sector. So this is where we are right now. I'm sure we'll give you more update along the day. Sirak, my colleague Sirak, Johannes, and the entire the licensing team, Stefanos, Samara, Yared, Salam, are here. So show your hands so that they can find you later on. This is the licensing team, so they can talk to you specific areas if you have any questions or concerns. So having said that, the credit rating agencies are the most important component in the capital market ecosystem, especially on the fixed income side. When we develop a capital market in Ethiopia, we're not only focusing on developing an equity market where, so of course it's exciting to have 20, 30, 40 different companies, but the story that we're hearing and then seeing in many parts of the continent is there is a strong, successful fixed income market in most part of the continent. I'll give you an example. When you look at Morocco, for example, Moroccan listed companies are very few, even though it's over 100 years, almost 100 years since the Moroccan exchange, the Casablanca exchange was established in 1929. But if you look at the fixed income side, right now, the asset management companies of Morocco hold over $54 billion worth of assets, and they participate actively on the government treasury and other corporate debt issuance. And the reason why this could grow and expand is at the back end of it, there is an independent credit rating entity that will look at this debt instrument and will provide an opinion. Of course, it's an opinion. It's not an opinion to invest or not to invest, but as part of the process of gauging if this debt issuance is attractive for an investor, there will be a much more holistic view of what's happening with this company, its capacity to pay and perform as it's obliged on the debt instrument. our prospectus would require a certain disclosure. But in addition to that, having a third-party credit rating agency coming in, giving opining on the debt instrument will give the investor even much more confidence for the company to attract more investors to come and participate. So this is kind of the preamble of why a credit rating agency is crucial. As most of you would know, there are several key areas that credit rating agencies provide in terms of credit valuation, risk management for investors, so that they can properly evaluate their risk appetite based on the report from the credit rating agencies. It would provide access to capital for companies, because once the instrument is rated, then whenever there is a favorable credit rating, the company is positioned much better than others in order to have strong access to capital. And then, of course, investors' confidence, because the more the credit rating indicates the holistic view of the company, in addition to a prospectus document that will be issued, investors will have more confidence, because the more information you have, the more you avoid information asymmetry between the investor and the institution that's seeking investment. There will be more investor confidence that will transpire. For us, developing a local currency bond market is one of the most important elements. We're working with IFC right now to develop a local currency bond market that we will fund our projects, will fund our growth, relying on our domestic retail and institutional investors. As you know, it seems that all our 30 banks and 18 insurance companies just came out of nowhere. But it's 27, 30 years of hard work and investment of over 390,000 Ethiopian investors who've created this banks and insurance companies. As you know, there is a limitation. No one single individual can have more than 2% in a bank share. That means the ownership is fragmented. You have 390,000 shareholders that own shares in these banks, and we can rely on bank-owned investors to make sure that they can participate also in the capital market ecosystem. So when we develop a local currency bond market, the rating aspect of it become important. But zooming out and looking at beyond Ethiopia, the credit rating agencies have attempted to absorb themselves from the ills that they've caused in 2007 and 2008 to the global financial crisis by punishing African markets. One example is, of course, Ethiopia. When we've requested a debt reprofiling under the common framework, this was 2021 in February. There was no indication of liquidity constraint. There is no indication of the government any intention to default. It's just a matter of prudent debt management exercise. But every credit rating agency downgraded Ethiopia, especially all of the three of them: Moody's, Standard & Poor, and Fitch. And they've used us as an instrument to threaten other African countries not to follow the same path of requesting a credit or joining the common framework. So we have a very strong view. I have a very strong view that we need to have an independent credit rating agency system in the continent that understands us. That most of I participated in all of them, and when they rate our credits in Ethiopia, none of them actually come to Ethiopia. They do it via Zoom. They don't understand the fundamental strength of this economy. They don't understand the trajectory that we have. Of course, they focus on that $1 billion Eurobond instrument, and always the issue is Ethiopia's capacity to pay or not to pay, as if a $1 billion for an Ethiopian economy is a big deal. But they don't understand the continent. That's my point. So growing credit rating business in the continent is very important, because we're not asking for favor, but we're asking to be treated equally. Because when you look at the data, a Latin American country with the same type of credit risk status gets a less pays less to borrow versus us. Kenya just a few weeks ago paid over 10% on a $1 billion or $1.5 billion bond issuance, where 5 years ago they were paying 6.25%. And the same type of issuance in Latin America will yield 5 to 6%, 7%. So we're being penalized for where we are, and because we do not have a strong credit rating agencies in the continent. So developing a credit rating business in Ethiopia would help our corporations to have institutions to evaluate them with understanding of what happens in the continent, what happens in our country. So this is one of the most important aspects of it. In terms of where we are, as I've said, we've started issuing receiving applications for a license. Credit rating agencies who wanted to participate in Ethiopia, they can do it in two ways. One is they can have an authorization to work on a certain date issuance, which means, for example, if our brothers from Nigeria would like to have, participate and open up shop in Ethiopia, we'll be very happy and we'll expedite the process before we go back to Nigeria. We'll issue the license. We'll be very happy. But if you wanted to test the market and see what's going on before expending the expenses, we can do an authorization with discussion with your primary regulator. So our capital market regulation allows us to have an authorization for companies that are established in other jurisdictions to be able to come and work in Ethiopia with authorization. And then, of course, when the market develops, this will be an attractive proposition for them. But these companies that we're looking into are right now we're in discussion. Regional players, definitely on the date side, because there are some companies who came to us who wanted to issue a data instrument, which we are talking to them. So the more information that they provide to investors, the better it is for them to also in terms of pricing. So with that, I'm very grateful for UNECA for allowing us to use this beautiful facility, and for FSD Ethiopia for all your hard work as ever, and we'll continue having this type of workshops. Of course, within these 2 days, we're not going to be able to walk you through the entire dynamics and complexities of a credit rating agency and how it works, but we'll try our best at least to ignite some curiosity and maybe an interest to work in the system, and then some of you may even request for a license. So with that, I really thank you, and I wish everyone a very good discussion. Thanks.
Thank you, Dr. Brook, for sharing your honest experience of dealing with credit rating agencies. As you all know, it's a very oligopolistic market dominated by the three of them that constitute about like 85% of the business. And the experience of Ethiopia and a few other African countries is a bit sad to say, and so undeserving. I've had a lot of instances where I raised questions on how it's being done, and the more I learn about it, the more I feel very concerned, and the importance of developing our own homegrown Pan-African rating agencies have become so much more important. I'd like to also pose certain questions for EK, because how does that work? Do these credit rating agencies use a one-size-jacket-fits-all type of approach? Do they rate like developed countries, developed nations, and some of the upcoming developing in the Eastern Europe and the rest of Africa on the same standards? And is it even fair? I mean, do you measure and compare an adult grown man with a toddler? How does this all work? I would like to understand more about that, and we'd like to pose more questions. We'd like to make it more interactive. And I think without further ado, I would like to pass on the baton to AK. Welcome today for this session. Please take it away. He would like to stand because he may find it a bit odd to sit down and conduct this session with you all. I might also find myself getting up once in a while. So with that, AK, please.
So much, Dr. Brook. Thank you for that. And thank you for saying that. Good morning, everyone, and it's a warm welcome here. Hope you can hear me. I thought I had a loud voice, but So it's a pleasure to be here. Excited to be here once again in Addis. Looks like home to me now. Coming every often. I'm not sure if I should use this. Let me just test. Can you hear me? Hello? Can those online also hear me? Those online, can you hear me?
Yes.
Okay. Then that's the case, and I can use the microphone. So I'll just do a quick introduction of myself and the team here, and also I'll now get into the presentation. So my name is Ike Chuku Ihagwam, or you can call me Ike. That's my Kenyan name. I'm originally from Nigeria, but I'm resident in Kenya. I supervise Augusto & Co.'s business activities within East Africa. So we have a regional office in Kenya that looks out for all markets. We also have operations in Rwanda, about to be in Tanzania and Uganda. Just like Dr. Brook had mentioned, Ethiopia is one of those markets we can't lose sight of, which would hopefully, by the end of this whole session, would speak and see where we can do, where we can participate in this particular market. But it's important to be here. And for us, we thank FSD Ethiopia, we thank UNECA, we also thank ECMA and other partners for making it possible for us to be here today to have this conversation on credit ratings. And just to give some perspective on so just to give some perspectives on how my session will look like, I'll start off by speaking around who exactly Augusto & Co. is, just to give you some insights on who we are, what we do, our scope. Then afterwards, I'll dive into the presentation and take you through the outline we want to run with. So Augusto & Co. is a 30-year-old company, purely African, without any interest outside of Africa, wholly owned by Africans for Africa. We pride ourselves being an African entity. Set up in Nigeria, that's where the headquarters is, 30 years ago. Previously, there wasn't anything about ratings known globally, especially in Africa. And Augusto & Co. thought, having got some insights from the founder, having got some insights from one of the rating agencies, decided to come back and set up in Nigeria. And from Nigeria, we decided, okay, we needed to take this good message, this good news to other parts of Africa. Then we went into Rwanda and Kenya in 2013, obtained licenses. And just last week, we set up in Ghana, 1st of March. We set up another office in Ghana. We're trying to expand our footprints across Africa. We're working with Tanzania, Uganda to get our offices open up in those places. Same with Ethiopia. Our view is to be a reference point for Africa, to have an African voice. Just like Fasil had mentioned and Dr. Brook had mentioned, we think some of the opinions are being provided by the big three may not necessarily completely reflect our views as Africans. And we think being on ground gives you a different perception, a different context to the issues on ground. And that's why we at Augusto & Co. pride ourselves as being African in nature, Pan-African, and we hope to continue in that particular light going into the future. So that's a brief about our history. Beyond being a credit rating agency, we do other things. We do research, because research is the backbone of credit rating, because you need to be able to understand the entities, the industries, the macro environment that you want to provide opinions on, to be able to give those opinions. So Augusto & Co. research is a fundamental part of our business. We carry out research for sovereign governments. Today we cover 6 sovereign governments. We cover Nigeria, Ghana, Rwanda, Kenya, Tanzania, and Uganda. Hoping to get Ethiopia on board on our coverage. So what we typically do is, on an annual basis, we review those countries, assign opinions, have sessions with the various government officials and key parastatals, and on the back of that, assign an unsolicited rating for the governments. And beyond the government, we now look at the industries played in those particular countries, because what we like to do is to explain that we want to understand the entirety of that particular ecosystem before we begin to assign credit ratings. Beyond that, we also provide risk solutions, which is why we are here today in terms of training and capacity building. We've done this across several markets. New markets are trying to set up ratings. We come here and speak about what exactly do you need to put in place, what do you need to make available from a policy standpoint, and also the roadmap towards getting ratings become an integral part of the ecosystem, especially the capital market. And finally, Augusto & Co. is also a climate bond standard green verifier. What does this mean? The world is turning into sustainability. Everyone is thinking about climate change. But the questions have been, how are we being appraised on the standpoint of our needs from a climate change perspective? Okay. Okay, good. So because of that, Augusto and Co., supported by FSD, went ahead to obtain a license from the Climate Bond Standard as an approved green bond verifier. So today, you go across Africa, there are 65 verifiers globally, but we're the only ones who have that license in Africa today to provide opinions on how green or how social your instruments are. So what does that do for us? It gives us capacity to be able to come across Africa countries that want to issue green bonds, social bonds, and validate their criteria with the global standards. Yes, we play at the global level, but we focus on the local market. And our licenses are only for Africa. We are purely African in all our approach. Ratings, just Africa, we don't do outside of Africa. For our verification, just within Africa. And those are the compliments we're bringing to this particular session today. We'll be speaking to you for today on credit ratings. Then we'll be speaking about the opportunities in the green, social, and sustainability space, which is what we call the GSS space. We'll speak to you the issuances that have happened, how we supported those issuances, what do we need to do in terms of Ethiopia being ready, setting up frameworks, setting up structures such that we can begin to attract those capital into Ethiopia for expansion, our infrastructure expansion, our growth and our development. And that's the key focus of our exercise for the next 2 days, trying to bring credit ratings and also tie it into the financing opportunities from the standpoint of climate change. Okay. Why are my slides not moving? Was anyone supposed to control the program here? It can't move from here because it's being controlled centrally. How do I get the slides to move, please? Because there's a central. Okay, good. So you can help us figure it out while I keep talking. So in terms of the scope for the next 2 days, day one would focus purely on credit ratings. We'll try to understand the history of credit rating. Yes, you can take it back one. Yes, day one, we'll try to focus on the history of credit ratings. Where did it all start from? We'll also try to dive into what exactly is credit ratings. I mean, if you're asked tomorrow, what is credit ratings? We need to understand what it is. What does it mean and what it is not? Then we try to explain the various types of credit ratings. And who exactly needs a credit rating? Why do you even need a credit rating? What is the purpose? What is the underlying rationale for a credit rating? Why do we solicit credit ratings? Then we also try to speak around the philosophy of credit rating. What's the rationale of the credit rating agency? What do they think when they're accessing you? We think about risk. Just to give you an insight, we think about risk. We're not concerned about the eventual outcome. We're thinking about risk. How do we protect? So it's a protectionist form of appraisal. So it's not necessarily trying to give you an opinion that supports or helps you achieve your goal, but it's an opinion that helps ensure that the market is not hot. So it's a protectionist way of viewing this. It's a risk mindset. So now, on the back of that, we'll also dive into what we call our methodology. How do we go through this appraisal? And we'll try to put out the methodologies across different subsets of sectors. The banking industry will differently have a different methodology from the real sector, same for the insurance. So there are different methodologies cut across different sectors. What we'll try to do in this particular session will be look at two major methodologies, which is the banking and non-bank institutions, and then the real sector. Those are two critical institutions that we'll look at in terms of the methodology, explain what exactly it means, how do we go about it, what are the appraisals. Then on the back of that, we'll also take you to the scoring. How do we score the credit risk? What exactly are those indicators, those parameters that we look at in assessing liquidity, for instance, profitability, for instance, cash capacity, your statutory requirements. So we look at that particular metrics under our scoring. And finally, we'll also speak to the benefits of doing a credit rating. What do you stand to gain as an individual or as an entity? Then for the financial system and also for the investor. And then we'll do some case studies. We've utilized them, two particular companies here in Ethiopia, Zemen Bank. I see some representatives from Zemen Bank. So we'll do some analysis of your institution today. And also we'll be looking at ItSwitch, which is the switching company. We try to blend both a financial institution and a real sector company. And in that particular exercise, we'll all be participating. We'll be sharing some case studies for you to review, give opinions. If you were to be a rating agency, what do you think So we've done some analysis already, but we want to hear your views. And that's where we'll have your participation in terms of, now that we've gone through the whole outline of what we need to do as a rating agency, assuming you are the rating agency, how would you view the risk of those particular institutions? And that's where we'll end today's session. Purely credit rating, but focus on trying to get us to understand what we need to do, how we need to do it, and what are those parameters that are important. So that will be our day one. For day two, we'll now dive into the GSS space, which is the green, social, and sustainability. It's a key term, or it's a key, a language that is being used in the market, GSS, and we need to understand what exactly does it mean. Green social sustainability will give to you about the history, the overview, where it started from, why climate change is important, what do we need to do as individuals, as entities, and even as government. What do we need to do around this space? What are the opportunities from the standpoint of green finance, social finance, and sustainable finance? Then we speak around the principles. There are governing principles in the market. What exactly do we need to know? What are the core principles we need to know? What's the market size? Where's Africa in all of this conversation? Every year we have the COP is held every year, the Conference of Parties, where they go to have negotiations on how much funds are going to be flowed, what commitments are being made in terms of greenhouse gas emissions, also in terms of what contributions countries need to make towards achieving the goals of 1.5 global warming limits by 2030 or net zero by 2050. All of those commitments we're going to review. Where are we and how do we posture ourselves on that? Also, we would now take some certification routes, trying to explain how do you get certified. If you have a potential transaction, you have a facility, you have a renewable energy plant, you have a water project, you have an infrastructure project, how can you attract green social financing to those projects? And those financing typically come at concessionary rates, meaning it gives a lower cost of capital in getting those kind of financing to execute those projects. We look at some of the projects that have been done, the routes to it, and then we'll do an X-ray of case studies. So tomorrow we'll look at a green bond and a gender bond, so which is a green and a social instrument. And we'll try to explain the features, what they did that made them successful, and how we can now begin to participate. And at the end of these sessions, we'll do a recap on how we expect Ethiopia to position itself and ourselves as institutions represented here. How do we position ourselves to get value from this space? So that's our outline for the next 2 days we'll be working with. We'd also want it to be as interactive as possible. So what I'll try to do is at intervals, I'll pause, because I know it's a lot of technical information we'll be sharing out here. I must preempt you with a lot of technical information. I'll pause at intervals, take your reactions, take your questions, provide clarifications, and then we'll move on. Again, I'm also not here alone. I'm also with one of my colleagues, Christine Wanjiru. She's our credit rating research and ESG specialist. Just say hi to them. Yes, so we'll be both here to deliver these particular sessions. But the idea was that we needed to just come here physically and explain a lot of these issues and see how we can begin to partner with a lot of the firms here going forward. So without much ado, I want to start up the session. But if there are questions, if there are expectations, what I also like to do in such sessions is to understand what are your expectations coming to this session, because I know you would have heard about what we want to do, but I'd like to understand what are your expectations. Maybe a few people to just tell us what exactly are your expectations before I display what our own expectations and outcomes are for this session. Maybe let's be sure that we are all aligned in terms of our expectations. So I don't know if we want to have a few persons, 2, 3, 4 persons, and we'd like to have gender balance in it, ensuring the females are represented. So just tell us, what were your expectations? I mean, when we're coming for this session, one from the private sector, the banking, the corporate, and also perhaps the government. We'll be happy if you can, just indicate your expectations. You can put on the mic and tell us what your expectations are for this particular session. Thank you.
Let me jump in real quick here. If you need to speak, please raise your hand. And then there's a button, a black button right in front of you. Turn that on. And then once you speak, or once you finish speaking, turn that off so that there's not going to be any echo, and we allow the next person to speak. So with that, we'll just open it.
Hello, I hope I'm loud enough.
Yes, we can hear you.
We can hear.
My name is Paulo Ruswata from Kufia. My expectation is very selfish. We want to issue an instrument, so we want to see how the rating will help us with the instrument we want to offer.
Okay, thank you very much. My name is Merit Bisrat. I'm from Pragma Capital. We're soon to be a capital. We're aiming to become a capital market service provider. So our expectation is basically being in the market for the past almost 6 years and understanding how the financial sector of Ethiopia works, and also at the same time understanding the benefit of credit rating. We want to understand. Our expectation is how can we first of all understand what's credit rating, and how can we understand it in Ethiopian context? Because as a soon-to-be capital market service provider, issuance of debt securities is very much important. So we want to, we want to understand and at least position our market to, to Nigeria and also other peer markets. Thank you.
Thank you. It's maybe on this side of it. We've had the men on this side speak. So we need to get some feminine voices on this other side. Can we have some feminine voices on this side, please? Or even some masculine voices to help us? Yeah.
Okay. Thank you so much. I'm Getnet Malak from Ethiopian Investment Holdings. So in this discussion, I would like to get informations about how to about the process of rating, credit rating is, and what will be the factors or KPIs to make a credit rating is on the companies, possibly on state-owned enterprise, and also what are the methodologies that we're gonna use for credit ratings, and also how can we utilize opinions since the credit rating is an opinion. So how can we convert the opinion into useful decisions? Thank you so much.
Thank you so much.
I'm assuming EK will allow me also to
ask expectations.
Exactly, not just as an MC, but also as a participant here. I'd like to bring it to a very basic level. I'm sure most of you have been in this space for a while and you've seen real estate companies selling apartments and houses, right? And they've collected a lot of money from home buyers. So the home buyers are creditors. Real estate companies have never been rated as being credit worthy to put your money into them. And we've seen a lot of cases of some of them that no longer exist. Some of them have delayed delivery for years and years, and some of them still actively collecting from regular people. So what does credit rating agencies could potentially do in terms of rating our real estate companies to ensure there's some sort of responsibility and accountability in their processes?
Okay, thank you so much, Fasil. Yes, I just need one more expectation, and please bear with me. Just a lady, so we have gender. But tomorrow we're talking about gender issues. So we need to have a lady voice in the room, and that'll be all. And then I can just respond to these expectations. And it could be from any side now. Please, let's just have a gender balance. I mean, we are particular. International Women's Day is on Friday. We need to promote that gender. I mean, that's key for us, even as an institution. We promote the gender. So we want to hear those voices. That's underhand tactics. That's what asking me to do. No, but I mean, anyone to volunteer, just tell us your expectations, or even not your expectations. You're just happy to be here. Let's hear your voice. Someone can bail us on, please. It could be from the regulators, it could be from the capital market, it could be from the banks. Anyone who bails us out will get a prize for International Women's Day. Perhaps we begin to make it more juicy, more interesting. Oh, fantastic. Thank you so much.
Okay, my name is Magdalene Taye from Magdalene. Okay. My name is Magdalene Taye from Magdalene Associate Law Office. My expectation from this session is what's the form of credit rating and also in Ethiopian context.
Okay, fantastic.
Thank
So the role. So thank you so much for your expectations, and they are very valid expectations. I mean, hearing you ask about you want to carry out an assignment, and therefore you want to understand the credit ratings, that will be covered in this particular session. We also had the expectation around you're being a capital market operator, you want to become a capital market provider, and therefore you want to understand the nexus between credit ratings and capital, especially for the fixed income or the debt market. That's also covered. The process of credit rating that asked in terms of the process and the factors and the methodology from EIH. Yes, that's also covered. We'll take that into cognizance. In terms of the credit rating agency for real estate, which is what Fasil asked. Yes, we have a session focused on the real sector. So some of the indicators will touch on real estate, but what we try to do at Augusto and Co is for each industry, we now modify the indicators because industry specific issues are different from another industry. And therefore, we don't have a one size fits all. So what I'll be speaking to you today will be on the banking industry that can be applicable to the banks and some non-bank institutions like the fund managers, and but we also have the one for the real sector, but it's now focused on the tech real sector, which is a technology related company. But all of those are the guiding principles, then they are now modified depending on the sector you're in. So if you're in real estate, we can modify a few of the parameters. If you're in trading, you can modify a few of the parameters. If you're an insurance company, you can modify a few of the parameters from the banking because you typically provide financial services. So that's the mindset we came here with. We also have separate methodologies for the states. I know in Ethiopia we have the 9 regional states and the 2 administrative centers. We have methodologies for the municipals, which is what we call them, and I'll speak to all of that in the course of this conversation. So without further ado, allow me to jump into our own expectation and our outcomes for this particular exercise. So we think and we believe that this particular session, what exactly do we want to? We want to equip you with the right knowledge, with the right insights on taking positions around credit risk. We want you to be able to understand what goes into the computation, the assessment of credit risk, because you're going to become a driver of that process. And therefore, we want to equip you with knowledge and the tools and the methodologies that are being utilized. And the methodologies are universal. What happens is that it's now being tweaked based on understanding and perception of those particular economies you operate in. Also, what we want to do is we want to empower you to be able to identify and assess and perhaps mitigate any potential financial risk you could see. Because the goal of credit rating is to protect both yourselves and the investor from potential default that can erode confidence in the market. The director had mentioned the crisis of 2007, 2008, global financial crisis, how the rating agencies were found corporate and they didn't do what they needed to do efficiently and effectively. But beyond that, some opinions were given, but the people take note of those opinions. Did they utilize the opinions to improve? Those are questions. So therefore, we want to empower you with those tools. Also, we want to ensure that we assist you in developing what we call an optimal capital structure. What kind of capital requirements do you need to have? Do we have statutory requirements that we need to meet? If not statutory, what is the balance of our debt and equity in our books? Do we have a 60-40 or a 70-30? So, I mean, all of those conversations is what we also want to achieve. And at the end of the day, we want to foster a collaborative environment where rating agency is not just that entity that sits outside, because a lot of times they think we are the bad guys. They think we are the bad guys who just come and appraise and give a bad opinion, or no. Rating agencies are expected to help facilitate the growth of the market, which is why we're having this session to enlighten you. So on one hand, we have the market deepening role. On another hand, we have like the teacher role, where we come and say, no, this is wrong. This is how it should be done. So there are two capsules there. We develop the market, we support the market. Therefore, we want you to see us as an integral part of this process. Not an outsider, but an integral part that understands your business, understands the industry, understands this market, and is able to provide you with solutions. So I just thought it's important that those are our outcomes. At the end of this whole session, we also draw a roadmap of where we think there are gaps, where we think there's room for improvement implementations, how we now have to have more of these sessions, maybe now focus specifically on the specific industry, where we drill down, we take industry by industry, bring players, and take them through, because what we are giving to you here is a generic for that to encompass all of them. But specific to each industry, specific to each type of financing you want. There's a rating that is suitable for that. There is now context to your local environment. I don't know I'm speaking about context. It's so important in ratings. Without context, you miss the ratings. So I proceed from here into the first sessions in terms of understanding credit rating. I guess this is not working, so I just have to rely on you to move the slides for me. Thank you. So when we talk about history, I mean, we like to draw the history back to the big three. They call them the big three rating agencies: Fitch, Moody's, and S&P. I mean, and one of the things you would like to notice is that a lot of these rating activities started in the United States, and they are mainly linked to what we call the railroad system. So let me explain what happened in those days before we go into the slides. Previously, merchants and customers used to trade across the railroads that were created in the US, and therefore merchants would provide you products on credit. But at that point in time, industrialization had not happened a lot. So therefore, the merchants and their customers were within distance that they could meet and exchange value. Even if I give you credit in terms of trade and goods, you can pay me back because I know where you live, I know who you are. But over time, industrialization happened, cities opened up, and therefore customers and merchants moved to various locations. And therefore, it became difficult to identify those particular customers I'm dealing with in those locations. And therefore, trust gap became a problem. How do I trust that? I give you financing 10,000 miles away, you repay back. Even though we're doing trades, and that's where Moody's, Fitch, and S&P came to play. We needed to find someone who was not on the merchant side and who was not on the customer side that could come into the middle to say, I can vouch for those guys. Therefore, you can advance your goods and they will pay when they've sold back to you. That was the origin of ratings. Because we couldn't keep doing deals. We were doing it when we were close distance, but because distance had occurred, and I wasn't sure what we were doing there, but I know I would sell to you and you make sales and return back to me. So therefore, the rating agencies came in to say, okay, we'll serve as that conduit. We'll say we know these guys, we can appraise them, we believe they have competence and financial character to be able to repay you, and therefore, you can advance to them. 60 days, 90 days, 180 days, they will pay back. So we put our reputation on the line that we have assessed them, and that's the history of ratings. So think about it. It's a trade scenario that started rating. Trades were going on without issues, but industrialization, globalization started, and therefore people needed to be sure of the counterparties. And that's where rating is all about: counterparty risk. Ratings is all about counterparty risk. They're trying to assess the other counterparty. Do they have capacity? Beyond capacity, do they have willingness? So that takes me back to the history. So John Moody first published the Moody's manual sometime around 1900. And from then he developed statistics, research. Ratings are based on research. He developed research statistics and said, okay, we need to now understand these railroad systems. We need to understand those customers at the other end and the merchants. And on the back of that, he developed a system of appraising and assigning risk weights and risk ratings to those counterparties that gave the merchants comfort to release their goods. That's how rating for Moody's started, John Moody's. You go to Fitch, John knows similar scenario. He was also into statistics, into gathering data. So which is why we always say, rating agencies without a research arm is not really a rating agency, because you need to be deep on research. You need to be big on research to support. Okay, let me go forward. Okay. You need to be big on research to be able to provide opinions. Research across different markets, different industries. And that's how John knows for Fitch started. And he published Fitch introduced the AAA to the in 1924. You go to S&P, they also started, but their focus was really on the railroad transportation system. But we realized beyond that, governments, corporates started thinking about issuing instruments to raise funds, and that's how it metamorphosed into various industries and various. But the origins is from railroad trade business, which is why till tomorrow, anytime you're doing an appraisal on credit, you want to look at the counterpart, his capacity, his ability, his strength. What can he do? Can he pay back? As at when due? Because if he doesn't, your other commitments as a merchant becomes delayed and depleted. So therefore, the rationale around rating falls on three key issues. First of all, independence. Remember, these people were independent of both the merchants and the customers. So independence is one of the critical values, critical pillars of credit rating. Without independence, you cannot be able to give a fair opinion. So independence is the first pillar upon which ratings rest on. So we are not saying we're going to be on the buyer side or the seller side. We're not going to be on the buy side or the sell side. We are going to be independent, which is why globally you will not see financial institutions, banks, own rating agencies. Because that means if the rating agencies would tilt towards giving preferential opinions. Same way with Moody's, Fitch, S&P, they are not owned by financial institutions. You can see government own a stake in some of those institutions, but the idea is they need to be as independent as possible. Otherwise, their opinions no longer reflect the risk. Think about it. If Augusto was to be owned by the National Bank of Ethiopia, what kind of opinions would we give? Opinions have to be favorable to the National Bank of Ethiopia. That's how it is. So the rationale is you need to be independent but licensed, so that you don't have what we call the moral hazard. Independent but licensed, meaning you need to submit returns, submit reports to the regulator. Regulator checks the work you're doing to be sure that you're still maintaining that independence. So that's the first pillar. The next pillar is integrity. For you to be a man of independence, for you to be able to provide independent opinions, you need to have integrity to show that you're able to say the truth without fear, without favor. And that's what has worked for rating agencies. Sometimes you may not like the answers they give to you, but the question is it fair? Does it reflect the risk that they are seeing? Then the final part is reliability. Ratings are not a one-off events. People need to be able to rely on your appraisals on a going concern basis. Companies operate in continuum, which is a going concern concept. And therefore, rating agencies have to be reliable, not just for today, but into the future. And that's why rating agencies try to ensure they don't get into issues that damage their reputation. Because once your reputation has been damaged, it becomes very difficult to be relied upon. One of the things we always like to make boast to say is that Augusto and Co, over our 30-year history, instead of 1992, we've not had one litigation, we've not had one court scenario, we've not had one bad rating. Not assign a rating that looks so good and therefore the outcome becomes negative. What I mean is you assign a very good rating and then the company defaults. We've never had one scenario in our 31, 32-year history to date for Augusto and Co, because we focus on the research. We focus on understanding. By the time I speak about methodology, you understand why this is possible, and it's actually doable globally. You can actually do ratings without missing, because there are certain things that need to be put in place. Context, one of those key issues. You can't sit in Chicago and understand what happens in Addis. You can't sit in New York and understand what happens in Nairobi. You need to be on ground. You need to have foot soldiers. You need to understand it. You need to interface with the people who are running those businesses. You can't know much more than the man who's running the business. So I just thought it's important to lay the foundation. The ratings depend on three things: integrity, independence, and reliability. Those are the three key factors that rating agencies depend upon, and they must have for you to be able to put up this appraisal. So allow me to dive now into what exactly is the credit rating. When we talk about credit rating, the first question that comes to your mind is risk. Think about it as risk. Some people call it credit risk rating because you have to put the risk. It's a measure of risk. What exactly is credit rating? It's an independent opinion on the credit worthiness of an obligor or an entity or an instrument. Independent opinion. Independence is showing back again. Remember our earlier conversation on the three pillars. Independence is showing back again. It's so important. And it's also an opinion. It's not an advice. It's not a recommendation. It's an opinion based on an assessment that has been done. And what does it show? It's an opinion on your credit worthiness. Now that's the big word. So the key words here is independent opinion, credit worthiness. What exactly is credit worthiness? I mean, let's take this into the room. What exactly is credit worthiness? If I ask you, are you credit worthy? Who thinks here that they are credit worthy? Your credit worthy. Yes, sir. How do you know your credit worthy? Your word is your bond.
Yes.
Sorry, the next person behind him, do you know, can you confirm that his word is his bond?
Apparently, I might need to see his financial status.
That's what I'm credit rating. Because you are saying your word is your bond, but the next person beside you cannot vouch for your word being your word because you need to test, you need to verify, you need to affirm that your word is your bond. Even if it's your best friend. The truth is, when push comes to shove, is when you actually know if someone's true test of character or true test of capacity can be met. So credit rating is a measure of credit worthiness. Now let's flip the question. Why should somebody not be credit worthy? What could make someone not credit worthy? I mean, let's flip the question differently. Why would someone not be credit worthy? Why would someone be credit worthy? What do you think would be a problem that someone is not credit worthy? Let's flip it. No, I want to hear thoughts. I mean, we want this to be interactive so that at the end of the day, you go back with your deep understanding. Why would someone not be credit worthy? Any voices in the room? Why would someone not be credit worthy? He has said he's credit worthy. Yes.
Maybe absence of credit history and records.
Fantastic. Thank you so much. No credit history. How do I know your credit worthy? Really? I can't, which is why in developed economies you have what they call the credit score. You have a score. As an individual, you're attached, the score is attached to you. Anything you want to do, they ask you to put your FICO score. Why are they asking for those score? They want to be sure of your history. So, meaning your history is a good way to assess you, but it's not a determinant of your future. Now that's where credit rating comes to play. History is a good indicator, but it is not a predictor of the future. And I'll give you a classical example. March 2020, we were all enjoying our lives as normal. Suddenly, pandemic, COVID hit. Businesses changed. Prior to that, businesses were doing very well. But what happened? Businesses took a different turn because of the pandemic. Businesses closed. People could not meet obligations any longer. So the history, if you look at the history before then, you'd have said these guys are credit worthy. But events had occurred that incapacitated them from fulfilling their obligations. So meaning there are some factors or some indicators that could occur that could impede or affect our credit worthiness or our scores. So what we're trying to do here is to paint a picture of what credit rating is all about, what the assessment goes to look for, and the whole goal of credit rating. So the idea is that it measures credit worthiness. Now let me pose a question to us here. Credit worthiness has two components: ability and willingness. If I have ability and I don't have willingness, am I credit worthy? I have ability, I have the money, I have the capacity, which is ability, but I'm not willing. Am I credit worthy? If we flip it the other way around, I am willing, I'm a good man, I'm willing to pay, but I don't have the money. Am I really credit worthy? Credit worthiness, you must have both of them present: willingness and ability. Willingness is a character issue, ability is a financial issue. We're beginning to drive home that credit ratings and appraisals are both financial and non-financial in nature, which is why you always see in credit appraisals there's a quantitative and there's the qualitative. This brings me to the big question around context. Quantitative, the numbers don't lie. If the numbers are there, the numbers speak. But qualitative, it's a function of perception. How I view you, how I see you. I mean, I can say, Sirac, because of his white beard, he's a good man. That is my perception of him. My first perception of him, which is character. But character is qualitative, but it can be measured. Do you think character can be measured? Character can be measured. It's possible. In credit appraisals, we measure character. So it's not just about perception. Character can be measured just like quantitative, your financial conditions can be measured. Now that's where context comes to play. How can I measure Sirac's character? There are methodologies to measure character. I can look at his history. I can look at what we call the KYC. All of those information supports the measurement of character. So therefore, in credit ratings, the goal is to achieve two things: quantitative appraisal and qualitative appraisal. You cannot focus on the quantitative, the numbers alone, and forget the context the person is, the character, which is why it's so important that for a rating agency, you need to have boots on ground. What is the macro environment saying? What is the industry? What is this person's context in that particular situation? You see where you can't sit in Hong Kong and determine my character here. Having not met with me, to have a session with me, to discuss with me, to understand my environment I play in, to realize that the reason why my business stopped is because they blocked a road, because they're constructing, and therefore I'm not able to actually make sales. But you sit in Hong Kong or wherever you are, you're not seeing that information. Not everything that happens on ground is captured online. Are you aware? We're trying to digitize everything, but not everything is captured online. So you need to have local presence. We need to have local conversations. And that's where context comes into quality. So it's so important to realize that credit rating, while it's an independent opinion by a party that is neutral, but it is an assessment of quantitative and qualitative metrics. So as we discuss on the parameters, you will see quantitative metrics and you see qualitative metrics. The big question at the top of your mind will be, so how do you weight them? Which should have a higher hand? Should quantitative be more than qualitative, or should qualitative be more than quantitative? I want you to start thinking about that. Which should be more? Should we focus more on quantitative, more on qualitative, or should we have a balance? And I'll give you the answer towards the end. Why do we need to focus? But let's take it as a teaser. Should we focus more on quantitative or qualitative? I'll tell you the answer at the end. Should we focus more on quantitative or qualitative than an appraisal? Let's hear from the room. In terms of an appraisal, we've established that it's a credit worthiness appraisal, quantitative and qualitative. But the question is, should we focus more on quantitative and leave the qualitative, or focus more on qualitative and leave the quantitative? That means should we focus more on ability and leave the character, or focus more on the character and leave the ability? Yes, sir.
I think it should be more the qualitative, because the quantitative is easier to determine. It's easy to determine your figures. It's much harder to determine your character.
So you are in favor of qualitative. One on this side for qualitative. Who thinks it's quantitative or qualitative?
I think it's better to focus both, because business is not straightforward. It is a science, but at the same time, it is also an art, right? So character affects a lot of things. At the end of the day, you could be the big boy in the town, but if you don't deliver, what's the point, right? So I think it should be both. Yeah, but context is the one that holds both together.
So which side did you choose?
Both. I can't. I really can't. Okay. If you okay, I would go with character.
Qualitative. Okay. On this side, what's our view? Quantitative, qualitative, and it's not as if they are true or they're correct yet until we go for the yes, sir. Balance.
We have to, 50-50.
So there's those for character, it's 50-50. What about those for qualitative? There should be some people here who are the financial experts. Those who are typing the numbers don't lie. Yes, sir.
Actually, I opt for both. In banking sector, we use actually 5 C's of credit: the capacity, character, collateral, condition that individual or company is engaged in, and also the capital that he put or the company put in that business. So it's kind of both actually. Yeah.
I would say ability. Ability, yeah. Maybe because I'm a lawyer, and there are options, to enforce. If someone is capable of paying that,
For me, it should be qualitative. You know what? Regardless of the ability that the data has, if that person is not willing, you will not get a penny. Therefore, the qualitative part is more the significant than the quantitative one.
Apologies, I would like to take a quick moment to recognize the 80 or so online attendees. Apologies for not asking for your expectations of this session, but do feel free to interact with us. Forward your questions by typing it out, and then we have our colleagues that will be sharing it with us. And then please do raise your hand, and if you raise your hand, we get back to you, but if you raise your hand by mistake, please take it down.
Yeah, so as much we need to strike balance between the quantitative and qualitative metrics, I incline and I say the quantitative aspects should outline, because there is a matter of subjectivity with the qualitative aspects, and we have to substantiate with evidences, and numbers speak louder on those circumstances. So yeah. Yeah, I'm from a corporate reporting background, so that's why I incline to that.
Can you turn on your mic? It's not been turned on. When it's turned on, it flashes red.
Okay, thank you. Those are important, but at the end of the day, we are rating companies based on their creditworthiness. So that rating should be objective, and to be objective, it should be more on quantitative aspects. What we do, the qualitative aspect that should be changed into quantitative as much as possible.
Okay, fantastic. I mean, I like your viewpoint.
Yeah, I'm not going to say like quantitative or qualitative, but I think it should depend on the specific deal that we are considering. It should depend on the background that we are having on the plate, and in some cases we might more or less push on the quantitative side, depending on the case, and on some sides where the ability of the person is not that much of important to assess the creditworthiness, we might focus on the heavier side, which is the quantitative one, and yeah, vice versa.
I never worked in a rating agency before. I mean, spot on. So the idea is none of the answers were correct or wrong. In credit rating appraisals, it's not a function of quantitative or qualitative to split 50, 60, 40. It's a function of the company, the industry you're trying to appraise. Some industries are heavy on capital, some industries are heavy on soft issues. So the idea is also the way a company is structured to determine the kind of methodology you want to apply, which is what we spoke about the fact that at the beginning we said different sectors will have different methodologies. For some institutions, they focus more on the quantitative, for others will focus less. I'll give a case, similar example. If I was to rate a blue chip company, meaning if I was to rate a blue chip company, give me one of the names of blue chip companies in Ethiopia. Blue chip meaning big international, well-known companies in Ethiopia, apart from the National Bank of.
That would be the Ethiopian Airlines, and we have a colleague sitting here.
Okay, fantastic.
From the Ethiopian Airlines.
I mean, the flagship carrier for Africa. I mean, I can agree to that. If I had to rate Ethiopia, and I realize that Ethiopia, based on our methodology, they fit into what we call a corporate name, a corporate entity, meaning they have very good governance structure, they have very good division structure, they have risk frameworks that are in place. I would focus more on the quantitative rather than the willingness. Because it's a corporate entity, it has a reputation at stake, it will not want to default. But it may have multiple obligations everywhere that it needs to meet. So I need to be sure that it has enough money to pay the obligations. So based on that kind of characteristics of the company, you determine what bucket suits it, and therefore you cannot decide to say, okay, I'll weight it 60% for quantitative, 40% on qualitative. Now let's take the reverse. You have a smaller company that is run by a family, also proprietorship. They're doing very well. But remember, their governance structure will not be top-notch based on best practices. They will not be well structured. Perhaps the president and the CEO still runs the finance business because he needs oversight of it. Therefore, that particular business, if I were to appraise them from a credit standpoint, I'll put them in what we call a retail classification or a commercial company classification. And therefore, I will not use the same metrics I've used for the corporate entity. Because the corporate entity, I can be rest assured that from a character standpoint, which is the governance framework and the boards that they have, they will not want to default. But from a capacity, for these other guys, they have good financials too. But because it's run in a different way, I'll put more emphasis on the qualitative. Because I want to be sure that this company, these people I'm giving this financing to, I'm giving this appraisal to, they will keep their words. Because they do not have as much at stake from a reputation standpoint. Yes, sir. Okay, good. Yes.
Well, how do you justify your position from the point of view of what we are seeing, in the globally? I mean, big corporates like Silicon Valley banks have collapsed overnight. In fact, their quantitatives and also their ratings were very high. Don't you think that, the character aspect really plays high role there?
Fantastic question. And I agree with you. And I take your challenge very valid. We're not saying you will discount qualitative. Remember, we said the weighting, the proportion will skew towards quantitative for those big corporates, which is why they had good ratings. But the qualitative part, it depends on what metrics they were looking at. The guys who are running the business, what's their skill set, what's their track record, what level of KYCs or KYCBs were done on them. So we're not discounting that there's a qualitative segment. There's a qualitative perspective to it. We're only saying that how would you balance it? Rather than doing a 50-50, you will not focus 50-50 for them. You'll do maybe 70-30, 60-40 for that kind of entity. But for the converse being a retail entity, you balance it the right way around to say, okay, I know you have good numbers, but I'm concerned about your character because you don't have that governance framework, reputational wise, all of those issues, and therefore I'll focus more on the soft issues. So that's the rationale around it. It's not because, and there are some institutions you do 50-50. So there are some you do 50-50 balance, 50 quantitative, 50 quant. That is the first stage of rating, is to identify which bucket does this entity fit into. And there are metrics. So I'll give you some of the metrics just for benefit of doubt. For the corporate entities, we expect to have boards of about 7 and above people, where they have independent members on those boards. Beyond board, we need to have a formalized organogram and structure that shows what each person does, their line, their reporting duties. Would have independent internal audits that reports to the board. Beyond that, their financial statements that they produce need to be audited by the big 4 agencies, which means that the numbers would reflect their position. And if you look at the audit reports of the big 4 entities, they're usually very voluminous because they take account into everything that the financial reporting standards have provided for. We have a metrics to determine where does this company fit into, where does this company fit into. Then on the back of that, we'll now apply that methodology in weighting. Yes, sir.
If I may, I mean, the big 4s recently, I mean, they've been populating the news. I mean, I don't know, like, it's very hard to say that we find them very much reputable because, in my view, the same thing that happened for the big 3s for the credit rating, right nowadays is just happening all over the world, right? So how would you align with that? It's very difficult.
I mean, I hear your viewpoint that is valid, but that's why they call the big 4 and the big 3s. They will always be that. So they will always be, I mean, in a cycle, the highs and the lows. We do not expect the lows to frequently come. So, I mean, the big 3s have had issues too. They've been in existence for over 100 years, which is the rating agencies. They rated the Silicon Valley, they rated Aaron, So there are cases, but there will be those slump, those periods. Same for the big four in terms of audits. But what stands those people out is the fact that their due diligence and the work that they've done and the history that they have and the reputation is huge. So not to discount the upcoming firms, the upcoming audit firms, but we're saying if your audit has been done through those big four, you've passed through some tests, some appraisal process, some review process that we can confidently say all of the IFRSs and the IPSAs that they've used align with international best practices. And therefore, not so much checks needs to be done. Because I mean, typically rating agencies typically have accountants in them too, because you need to understand the numbers and interpret them before you start doing analysis. So most of us are chartered accountants at Gusto & Co, because you have to have that basic accounting knowledge that you now translate into risk assessment. Because risk assessment is different from accounting. But then I begin to explain the things we look at, they look financial in nature, but they're looked at from a different perspective. The way a bank or a banker sees accounting or sees credit is different from the way we used to look at it. I mean, I used to work in the bank. I spent 6 years in the banking industry before I moved into the credit rating space, where I spent about 11 years. It's different. It's a different perspective. And I'll try to break that down when we get into the method. But it's important here to state that what are we trying to establish here? Credit worthiness. Quantitative, qualitative. There's no one size fits all. That's the message I want to draw here. No one size fits all. So the same methodology we used for Zemen Bank, you can use it for Oramio Bank, for a bank, because they play in the same space and they should have similarities. But you can't use that for an insurance. You can't use that for Ethio Telecom. You see where I'm coming from? Because they're different methodologies. Also, the kind of weights you put will not vary in industry, but it will vary per industry. So let me explain. It will not vary in industry, but it will vary per industry. Meaning, if I was to put for the banking 70% on quantitative, 30% on qualitative, because they are regulated by the National Bank of Ethiopia, they have strict rules and requirements. I'm focusing on the quantitative, saying they may have a lot of obligations, but if from a character standpoint, the Bank of Ethiopia, National Bank, gives me comfort that they submit returns and is providing an oversight on them. So therefore, do I need to focus more on their qualitative factors? Not necessarily. So I focus more on the quantitative. But that's for the banking. I switch into the corporate entity. Does the corporate entity have such kind of supervision? Not necessarily. So therefore, my weighting for qualitative will go a little bit higher compared to the banks. You see the dimension? So it is per industry. But within the same industry, like the banks, I would use the same metrics because I want to be able to compare the performances together. Are we still together? Are we still together? Okay, it's a journey we're on. It's a journey of unpacking credit ratings. So now that we've understood two key issues, independent opinion, first, and second, credit worthiness, quantitative and qualitative. The next question is, what exactly is a credit rating in itself? You have a question, sir? Okay.
So based on the point that you highlighted, so more of you focus a lot of research on the industry then, right? Because as you correctly said, like, okay, if I put Zeman on the spotlight, it would apply for the other banks, but I would approach a different approach for the insurance one. So you have to do a thorough assessment of industry.
Exactly.
Right.
So when I speak about our methodology, you realize we start from the macro, then we get to the industry, then we now get to the company itself. That's what informs our methodology and our parameters. So it's industry focused. It's not company focused. It's industry focused, which is why we now benchmark you against the industry averages. So one of the things I didn't mention in my introduction is that for all the countries we operate in, we release industry reports, independent industry reports on those industries we have clients we're playing, so that they know what the industry averages are. So that if we are praising you, we know you are praising you vis-a-vis the industry benchmark and perhaps the best in class in that particular space. Because we want to be able to show the comparativeness, where you are vis-a-vis others. So what exactly is credit rating? Independent opinion. I need us to take this back. It's an independent opinion, and also on credit worthiness of an entity or an instrument. Now, credit rating is not a recommendation to purchase sell or hold or buy financial assets. We are not the equity analysts who tell you buy this particular. Once the exchange sets up, equity analysts will start releasing a lot of equity analysis saying buy, hold, sell. That is not what a credit rating is all about. We don't give opinions to buy an asset or buy a share. No, it's not an equity opinion because we don't measure asset value. We don't measure your asset valuation. No, we don't. We use that in our analysis, but that's not the purpose of a credit rating. It is also not an equity opinion, meaning we're not telling you to create value for your share. Whether you create value for your share or not, our role is to provide you an independent opinion. And finally, credit rating is not an audit. We are not doing an audit. We would have done an audit already. Because for you to be rated, one of the requirements is to have an audited financial statement, regardless of who audited it, but we need to have an audited financial. So we are not doing an audit. We are only reviewing the audited financial statement in the context of putting it into our methodology and our rating process. Are we together? However, what exactly is credit rating? It's an independent, objective assessment. The objectivity there lies in the independence and the integrity I spoke about as the pillars. So it's an independent, objective assessment of financial condition and your ability to meet your obligations. And here we're looking at the quantitative and the qualitative, character and capacity. Just like my good friend has said, in the 5 C's, there's character, there's capacity, there's condition, there's collateral, and what's the final one? What's the final C? Character, capacity, condition, collateral, and capital, equity. So the idea is those first 2 are the critical because they influence the others. The other C's are important, but character and capacity is quantitative and qualitative. And therefore, we dive deep into it with different parameters to examine it. And also, credit rating is dependent on information. Without information, we cannot provide an opinion. So sometimes rating agencies, because they don't have insights of what you've done, they abstain from giving an opinion. And we do that a lot at Augusta & Co. If we request for certain information, certain insights, and you're able to provide them, which we think are material to our assessment, we can withhold our opinions. We are not under obligation to give an opinion if we don't have, information on the same. So what that means is that the more credible information you provide to us, the more credible our opinion will be. The less information you provide to us, the less credible. And I've seen this in practice a lot, that a company comes, we do an appraisal for them, we come up with a rating outcome, and they are dissatisfied with the rating outcome. We say, okay, go through an appeal. What did you not tell us during the process? And they now start unpacking that, for them, they felt they were giving too much. But we sign an NDA with you, a non-disclosure agreement, so that you are at liberty to give us all of the information that we need to carry out our assessment. I mean, information as far and as wide as you can think. It's a very thorough process that could take sometimes close to 5-6 weeks, going through all of this whole assessment and review. With your teams, your different, and it's not just the business leaders. A lot of times they just look at the business leaders and speak. No, we speak to the different teams. What are they doing? How are they tying up into the big vision, the big strategy, the big appraisals? And it's not just a historic assessment. We're also assessing you into the future. So meaning we take your history numbers, we take your budget, take your forecast, and do sensitization. So it's a whole exercise. And at the end of it, we now convey it in an alphabetic numeral scale, which is the AAA to D I mentioned that John Knowles of Fitch started in 1924, because that's the global way of trying to explain it to a less sophisticated investors. They see the AAA, they know AAA means highest, and all of that I've explained what it all means in this session, from the AAA to the D. So that if you see this client or this entity has been rated this, what does it mean to you? It's a reflection of the risk. So it's not because they are bad or good, it's their risk profile. And therefore, because you now know their risk profile, you're able to price them appropriately. So what does a credit rating do for you before we get into the benefit? It's to help you price the risk of your counterpart. I know your risk. And in finance, we say the higher the risk, the higher the return. The lower the risk, the lower the return. So that's what rating does for you. Helps you determine what premium do I need to do what charge on this client, because he has a high risk. And because he has a high risk, I need to do what? Take a higher premium on it. That's the thinking around this session. So I want to take some questions, then we'll take a pause. we take a tea break, and I'll come back. Just to be sure that we've gotten this foundational knowledge on what exactly is credit rating, what it is not, what are the things we look at from the quantitative and qualitative perspective. Thoughts, comments before
Just for my knowledge, who rates the credit agencies?
Yes, I love that question, and I have answers to that question. And we have regulators. That's why we have regulation. So, what regulators, which is why the book was saying we need to come get licenses. So they technically rate us because they now have their own appraisal system to say, okay, what have you done in the past? How did you arrive at this? The methodologies you've used, can you come take us through it so that we also have an understanding of it, and therefore we're able to checks and balances, check what we do. So in all markets, the regulator is the Capital Market Authority, regulates our activities. In Kenya is CMA Kenya, Rwanda is CMA, in Nigeria is SEC, in Ghana is SEC Ghana. So that's how it works. So they are like the watchdog. The same way the National Bank of Ethiopia watches over the banks is what they do over us. So they don't give us a score like we give a score, but they give an opinion on, because sometimes it can derail the capital markets. Ratings can derail capital markets. One bad rating can have a run on another market, and I'll speak to that in a subsequent conversation. But thank you for that question. Yes, sir. Any other? We are happy to. Okay, yes, sir.
It is a kind of follow-up question with a question raised a while ago. Maybe a kind of example, how were the first rating agencies established in Kenya, Nigeria, to which I think you are familiar with, because we have a lot of history with regard to Moody's, Fitch's, and so on.
Okay.
So I think.
Thank you so much for your question. So how did the rating agency start? So let me take it back a little. It started in 1990. Our founder called late Bode Augusto. He used to work for one of the big fours in US, and then he was always being appraised because he was part of the team facing the rating agencies when they come for appraisals. And they wanted to understand why exactly, what is the purpose of all of these ratings? And he developed interest in it. And he went for trainings. And then he moved back to Africa, he moved back to Nigeria, and said, who does rating here? People did not understand what exactly we rating because the deals were not happening here that required rating. Most were on arm's length basis. Companies, nobody. So he now thought about it and went to do more studies, went to do more training, and came back to Nigeria to set up the rating agency business. So in Africa, rating agency business actually started in Nigeria, changed in 1990. So he came up and started doing research on banking industry, started with banking industry, started doing research and give opinions on what exactly are these people doing, because he had some knowledge. And on the back of that, he brought in some people who had gone for trainings on ratings. They now started looking at, okay, this is something we can do here. It has never been done before, never been established. And that was when Augusto and Co. was bettered to start providing it from a research, on a solicited basis. Then people began to take interest. Then the three big rating agencies decided to now start doing business across Africa. That's the investors were looking to put funds here, and the investors wanted comfort, but not from the local people, from themselves. And that's where they started. And that's where all of the other rating agencies in Africa, GCR, Wara, Bloomfield, they all came up after them. So we usually say Augusto and Co. were the pioneers because it was knowledge that was not relevant or present here. We just knew about it, had knowledge, but we didn't put it in practice. And therefore, Augusto set up in Lagos, Nigeria. South Africa, GCR set up some 3-4 years after that. And then we started expanding. You moved into Kenya. It wasn't done in Kenya at that point in time. We introduced it into Kenya, same in Rwanda. Now we're trying to introduce same in Tanzania, Uganda, and Ethiopia. So it's a market that not everywhere in Africa is rating being done. The best that is being done is what they call unsolicited rating of the national, which is the national government. Because a number of activities that would spur capital market operations, fixed income, is ratings. I don't know who I'm giving these funds to, but the rating agency, who is the independent middleman, has checked and has given me comfort that I can go ahead and play or invest in this particular instrument. Yes, sir.
We have a question from our online attendees. I will paraphrase it in a way I understand it. There's a question from Ngada Bayu, who's attending on Zoom. It says, is it better approach to start a rating company in collaboration with established firms abroad, in Africa or elsewhere? That's the question.
Ooh, big question. So we like to be Pan-African. So I mean, my answer will be obviously in the Pan-African way. I mean, the idea is there's nothing wrong with having international relationships, but the question would be in the dynamics of power. What they call dynamics of power. Would you be influenced? Would you be able to stand independent? So there's that dynamics of power, and I won't want to get into the politics of it, but the idea is we feel homegrown agencies, homegrown rating agencies, have capacity to say the right things without being influenced by the West. Because again, sometimes people say they have an agenda, and we don't want to buy into that they have an agenda or don't have an agenda. But I mean, to answer that question directly, our view is to be homegrown, local for Africa, specialized in Africa, without any influence from the West. Some other agencies have affiliations with the West. It doesn't put them in a stronger, better pedestal because we all ascribe to what we call the IOSCO standard, which is the global governing body. So, which is one of the things I forgot to mention. Both the big threes and ourselves subscribe to the same international codes of conduct and ethics, IOSCO. So, I mean, we'll have the same methodologies, maybe tweaked a little bit differently because of context and what you understand. The same approach. And rating is, if you understand the technicalities of it, what needs to go to it is not different. So really, affiliation with international, yes, it can provide you some, but it depends on the power dynamics. Are you really in control or not in control? So I'm not sure I have an answer to that question, if you ask me. Thank you.
There are two more follow-up questions from our online attendees.
Okay.
What safeguards have you taken to avoid what happened in the 2006 global financial crisis and the role credit rating agencies played for that collapse? And second, is the credit rating related to a collateral valuation, which we already have stated that it's not.
It's not a collateral valuation. So that one is very easy to answer. Right. Not collateral. Now, what safeguards? So one of the things that have come up from all of the financial crisis has been who assigns the rating? Who assigns the rating? That's a big question we think we need to also answer in this room. Who assigns the rating? Is it the supervisor, the manager, the analyst that does assessment and assigns the rating? No. There's what we call a committee. Now, that's a part of the safeguards. So a committee sits and reviews, and this committee must be people who have all of those three qualities I had mentioned: independence, reliability, and integrity. But not just that, have an understanding of the markets. So, and it's not one person in the committee. Usually, minimum of 4 people in the committee. And the committee members, as part of safeguards, are not expected to sit in a quorum like this. They're expected to do what? Sit independently with the team who has prepared and reviewed the analysis to get insights before they make their opinions. But already there's also what we call the proprietary model that you would have used. So there's the model, an AI-generated tech model that you put in all of these details that gives you a score. But that score, remember, is technology, garbage in, garbage out. Somebody needs to validate, review. So that's where the analysis, the committees now have sessions with the analyst and the team have prepared a report before they give their own opinion on the outcome of that particular model. So there's a rating model that exists, but the model is not the final say. The final say is the committee, and the final say of the committee is not one person, it's the committee having unanimous or majority. So that's what we call the unanimous rule, where everyone agrees, or the majority, where they are split. It's like you have your judiciary, where you go for the Supreme Court and they have 7 judges. You need to have 4 on your side to pass through. It's the same idea. So therefore, rating agencies, so which is why when there are challenges with ratings, the unveiling of the challenge or the problem or where the fault comes from starts from the committee, goes back to the analyst, goes back to the reviewer. So there's which I'll talk about the process. There is a whole lot of people involved in the process. So really, you can't point one man to have been the person that I would have assigned or impacted on a rating outcome for an organization, for a country. And so that answers the question around safeguards.
Yes, there are more questions are coming from our online attendees on Zoom. I'll pause it here for now. But to take a real quick recap of what has been discussed, our colleague Merit had mentioned about the big 4 and the reliability. And I also agreed with the big 3s and all the questions that have been raised. You know, there's a documentary about the watchdog that didn't bark. You know, the watchdog is a credit rating agency that didn't bark. It's a regulator that didn't bark. It's also the auditors that did not bark. And I think that's one fantastic documentary you can watch. There's also a book around that. Also, talking about the history of how rating agencies started with railways, maybe our history starts with the real estate companies. I mean, it's a question for you all to think through. I'm making that connection when I talked about EK talked about the start of the credit rating agencies in the US. We collected many of you who are a finance director, a CFO, a treasurer from your company, from your banks, from your insurance companies that are here. Why that is so important is because you are sitting front and center in that interaction between your company and the rating agencies. EK had mentioned a situation where some information is not being shared and then a rating differs from what you expect it to be, and then so there's some information that we need to share you. I mean, that transparency is so much more important because that rating means a lot, and rating is attached to the cost of funding. EK said that we don't value a debt security, an issue, or a fixed income securities or security, but it's a rating that determines a yield. A downgrade means yield spreads, the spread widens, which means the price goes down. An upgrade means the spread tightens, the yield reduces, which means price goes up, and it plays a central role. We may think that's like a school grade where you scored an A or B or A plus or B plus. I mean, I'm sure there are better ratings than what I'm just saying, but it attaches to a value of your debt security. Is someone going to put in money or not? And there's also been a discussion of character versus ability, which has been quite interesting. We will continue on more of a discussion because we have some of our folks from the banks. There's been an issue yesterday from Kenyan banks that have been issued a warning because of the NPLs. What does that mean? I'm sure EK will speak more about it. We also have some of you from the insurance companies. What does that mean? What does a credit rating means to your ability to underwrite policies? Can you underwrite bigger and bigger policies? Do you pass on most of your premiums to a reinsurer? Or do you still have the ability to pay losses when they occur? And that credit rating also becomes so much more important for our insurance companies. Most importantly, counterparty. That has been discussed. When we say counterparty, it's not about like the entity that you borrow from or you lend to, but it's more about like you do business on a daily basis. How many of us check a credit rating agency, a credit rating of a certain company before we even get into a business with them? So those are all the more important takeaway points from here. I would like to break it here. And there's been a request for all of us to collect in one space. I don't even know where to take a group photo. It's going to be outside. The walk is going to be quite refreshing. On your way back, you'll grab a coffee, and we will return in exactly 20 minutes. Hopefully the walk takes 5, getting together another 5, and a photo 5, and then 5 minutes for your coffee break, and then we'll be back before we convene for a lunch somewhere around like 12:30 or 1 in the afternoon. Thank you so much. And our online attendees, you can also take a break and then come back with us in about 25 minutes from now.
Hey, John.
We have an algorithm that selects quantitative data sets.
I think the last question was it depends on the circumstances. How to quantitative.
There's a group photo report. Yeah, I think. Yeah.
Yes, original, last original. Here.
Ready to brew coffee? No. You're not a big coffee person? You're in the wrong place? I mean, they love their coffee here.
Listen, discuss myself. Any morning, it's all day. We're not in between. Don't be handsome.
All they have the same place. Oh, sorry. You avoid.
One morning, I'm going to forget you. Okay. I will be to. So you guys are looking to it. Yes.
For some, to come and do an assessment of the market here, find out how we can raise, how much, just give them story. Technologies. It started as a technology company issuing technology to help payment systems and so on. So I went into my school. Now they're really looking at micro mainly. So company must have that's like yeah. So they don't make a Mastercard Foundation. And I guess these people also have to go against the schools. So Mastercard what is right
እና እሱ መኪና ውስጥ ትከቸዋለች
but this is the 5 year
ወደዛ ማድረግ እና እዛ ሲመጡ ምናምን ስራው ተጀምሮ 3 ሰዓት እንደሚያልቅ እንደዛ ነው ተስፋ አሁን እኮ እሱ ሰጥቼ ልመለስ አንተ ጋር አሁን አንተ አሳይን ካላደረግከው እኮ አሳይን ካላደረግከው እሱ ሲመጡ ልመለስ ነው እሱ ጋር ሄደህ እንትን ባለው ነው ሁላችሁ እንደዛ እንደ አመሱ ከሆነ ብዙ የሚያደርግ ሻውን ምን እንደተፈጠረ ታውቃለሽ እሱ አቀብቼ ልመለስ ነው እና አይ አንተ ከምትመጣ እኔ ለማድረስ ለማንቀሳቀስ የሚመጣ መኪና አለ እሱ እሱ
Can we all start taking our seats? We have to get started. We have about 3/4 of the day ahead of us. I'm asking everyone to take a seat, reconvene. Great. So I think we could get started from where we left off. I left EK with quite a few points about like the watchdog that didn't bark, the transparency that's required from the finance department, the financial director, a CFO, so the treasurer, or any direct reporting to the FD or the CFO. We talked about counterparty risk, how credit rating allows us to assess a counterparty. We talked about also, or I talked about at least, what a rating means to banks, insurance, and the financial institutions in general. I would allow EK to take it away to the next session and continue to invite you to participate, interact. We also have our online audience. Feel free to share us with your questions and comments, and we'll make sure that you get engaged. EK.
And welcome back from our brisk tea break and photo session, 2-in-1. Good. But I mean, I think it was good also to get a lot of the engagement and while we had that session, that break, which means, I mean, we're all in tune. We're trying to understand the conversations around credit rating. And I think one of the things I would just like to just re-echo before we dive into the conversation is why credit rating, why it's important, why is it a tool to, I mean, galvanize capital markets. I mean, we think for economies to develop, the capital market is at the center of such development because we're able to attract both local and foreign capital. And for you to be able to demonstrate that you can attract those capital is the fact that you're able to repay those capital back. And therefore, the rating becomes the watchdog, in the words of Fasil, to give comfort to the providers of capital that this particular organization, entity, or government would meet its obligations as at when due and in a timely manner. It's so imperative, it's so important that we understand the key role, and which is why, I mean, I think someone asked during the break, so really, why are there not so many rating agencies everywhere? You find that there are very limited numbers in different climes because the idea is the sophistication, the technicalities, and also the fact that the regulators need to have some form of oversight around the activities limits the numbers to a maximum of 5 in most locations because you want to be able to ensure that the rating agencies are not proliferated, because when they become too much, then it's just a matter of competition, a matter of assigning whatever things will position them for value. But from a credit rating standpoint, it's supposed to be an independent opinion, guided on those 3 key pillars I mentioned: independence, integrity, and reliability. And there's a science to all of this, which is part of what we'll be discussing subsequently, the science, the mechanism behind it. But it's important to also mention that Beyond the science, there is the parameters you need to look out for, which is where the quantitative and qualitative assessment we've spoken about all through the morning comes to play. Creditworthiness. How can you demonstrate creditworthiness? Is it by having the money in your pocket, or by being willing to pay, or by not having the money and being willing to pay? I mean, I'll tell you one of the jokes to just put this in climax. My father used to say that a good man without money is not really a good man. A bad man with money is not really a good man. So where exactly is the good man? The good man must be someone who has money and is also willing. So having financial capacity doesn't make you good. Being a good person in terms of character without having the money, who will pay the bills? So you need to find a balance of those two. I mean, so it's important to understand this at every point in time that character alone is not enough. Capacity alone is not enough. We need to blend both of them. But what blend do we put? 50-50, 60-40, it all depends on the entity or the organization we are dealing with. That will determine what do we tilt higher in the spectrum of weights. And that's what I wanted us to take from the first session. So now let's dive into subsequent conversations around the types of credit ratings. I think our slides have stopped moving again. But what are the types of credit ratings? Globally, there are two types of credit ratings. There's what we call the issuer credit rating and the issue credit rating. So when we talk about everywhere you go to, ratings will either be an issuer rating or an issue rating. An issuer rating could be called an entity rating or a company rating, which is focused specifically on that particular entity. And it is an assessment of the ability of that company to meet its general obligations. I see our slides have not turned, but I mean, let's continue. No, this will not work because this has not been put into it, so it won't work. So, in terms of issuer rating, the focus is on that entity. We're appraising Augusto, we're appraising Zemen Bank, we're appraising your entity as a standalone and giving an opinion on your ability to meet your obligations. Now, when we switch to the issue rating, which is now on the instruments, the instrument rating is a function of the issuer rating because somebody has to issue it. So meaning an issue rating is a higher value or higher version of an issuer rating. So let's rewind and take it back a little. An issuer is an entity, a company, a bank, an organization, a municipal, a district, a council, a state-owned enterprise. Those are all entities. So they can get a rating for themselves to understand their credit strength and their ability to meet obligations. Now, when that particular entity organization decides to issue an instrument, which could be a commercial paper, a bond, a sukuk, I mean, we'll list out all of those instruments. That is an instrument. That particular instrument could have specific characteristics and features that needs to be appraised that have credit implication. And therefore, when you appraise that instrument, it is called an issue rating. But remember, you can't have an issue without an issuer. Somebody has to issue it. That's the thinking. Somebody has to issue. So which is why an issue rating is both a combination of an issuer rating and an assessment of the instruments. Two ratings globally. They are not beyond this. Any name you call it, it falls under these two categories. An issuer rating, the rating of the entity and its ability to meet its general obligations. We're not specific to a particular instrument. We're saying the entirety of your obligations, can you meet it on a going concern basis? We assign you what we call an issuer rating. So a corporate entity, a municipal here would mean in some countries they call them states, in others they call them counties, in others they call them districts. Those semi-autonomous, autonomous and government councils that have their own presidents or governors or whatever they call them in those locations. So the idea is that an issuer rating focuses on that company, that entity. When you now move to the issue rating, it goes to the instruments that they want to issue. How do you intend to raise money? I could not just say I want to raise money as a company, and because I am this, that is that. No, you need to demonstrate via an instrument, which will become a legal contract. You're contracting between yourselves and the third parties that are putting finance. And therefore, that particular instrument will have characteristics, will have features, will have the tenure, will have the rates, will have. That is what The rating agency would now look in when we are doing an issue rating. But we cannot look at an issue rating without looking at an issuer rating. So the first step is typically to do what? An issuer rating. Then on the back of that, you can now say, okay, what is the structure? What are the characteristics? Are there any credit enhancements? Like you have guarantees, you have liquidity supports, you have securitizations. Are there any, or you have collateralization where you have collateral values to support that particular instrument? Then all of that will be appraised, and then you now assign what we call an issue rating. So issue rating you have will be commercial paper. It's a paper you are issuing to the public to subscribe, or privately for them to subscribe. What are the terms of those paper? That's what the rating agency will be looking at in an issue rating. But who is the issuer? We need to also appraise the issuer. If it's a bond, which is long tenor, because commercial papers are short tenor, usually not more than 270 days in the standard way of issuing commercial papers, though they could be revolving, meaning it could now be rolled over into subsequent cycles, but it has a duration of usually less than 1 year. It's mostly for raising working capital finance. You need to buy, trade, do things, and you don't want to take for a long time because you need monies for today and you repay back as you dispose of, you get value and you repay back. So commercial paper works. Or you go through the bond where you want to take a tenured facility more often suited for infrastructure development finance. You want to finance a big project. I mean, I've heard about the Ethiopian Djibouti rail, the famous one. I've even heard about the dam, the Grand Renaissance, Grand Ethiopian Renaissance Dam. Such kind of projects, you can't use commercial papers because they are long tenured and the payments will come in the future. So you use bonds because bonds allow you to raise for 5 to 20 years and above. You can raise long tenured instruments and therefore structure the payments. Those kind of appraisals would go with an issue rating. But remember, you can't do an issue rating without understanding who the issuer, because some of the risk rests on that particular issuer. Why? And another part of the risk rests on the instrument, the quality, the characteristics of that instrument. So it's important to distinguish the two. You also have various instruments like your sukuks, your ijara, all of those leases that are used for maybe property, residential, real estate investments. All of them are instruments that are being issued by an entity, which is called the issuer. Also, you could have what we call the structured notes. You have receivables you've sold, you have receivables, you securitize those receivables, or you have mortgages for people who are taking, they put those mortgages into a pool and securitize them. They're all called securitizations. It's a higher level, complicated because of the added analysis that needs to be done. But all of these exist. Or you have what we call the asset-backed securities. So all of these are all instruments that would attract an issue rating. So globally today, if you come across any rating report, the question you should be asking yourself is, what have they assigned? Is it an issuer rating or an issue rating? An issuer rating is on that entity, and an issue rating is on the instrument. It's important to put that those are the two major, in fact, not the two major, those are the two only types of ratings that exist anywhere in the world. It's either you're issuing an issuer rating for the government, you can issue a government rating for the government of Ethiopia. The government of Ethiopia decides to issue a bond, you can rate that particular infrastructure bond and provide a rating. Same way for the companies. So that's the understanding of credit ratings. Issuer and issue. The assessments are different. Issuer focused on the entity, issue both the entity and the instrument. So it's a higher level. Okay, we move. But I mean, are there questions here? Because I know this is also another fundamental area we need to distinguish the issue and the issue. Are there questions?
If I may. So from the issuer perspective, I'm sure, is there a major difference in terms of how you differentiate for a fixed income securities that might be issued by a municipal bond, by a state, or by a sovereign nation, or probably by state-owned enterprises? Is there like a major factor in your assessment?
Okay, yes.
Because all of them are government entities.
It's government agencies, yeah. Yes. Thank you so much. I mean, that's a very interesting question. Now, the question we would ask ourselves is, those municipals, state-owned enterprises or government agencies, are they issuing instruments? If yes, the next question is, those instruments, do they have any support from the national government? Now, some countries have constitutional requirements that state-owned enterprises cannot raise instruments without the credit backing of the national government, meaning the national government puts a guarantee. I'll give you an example. In Kenya, you can't raise as a municipal without the national government putting a stamp of guarantee on it. Does that exist in our constitution or in our laws that the regional states, if they were to raise capital, that responsibility, the risk, leaves the entity and goes to the national, because the national will issue a guarantee. So what happens is, in some other climes, it doesn't exist. Those municipals are somewhat autonomous, that they can issue on their own, depending on how the federal character has been structured, federation has been structured. Ethiopia is a federation in terms of the Republic of Ethiopia. What it means is that there will be significant linkages between the national government and those regional states, even though the regional states have their own representatives and their own leaders. So therefore, there will be a lot of linkages. I have not searched your constitution to determine if clearly there is some guarantee that needs to be put in place or not, but in practice, for federal economies, federal countries, those linkages typically exist, because the debt of one of the municipals is as well as the debt of the national government. So maybe in-house here, and maybe our lawyers would help us. Is there any linkages between sort of guarantees that the national has to provide if the sub-nationals or the municipals have to raise instruments? This is from a legal standpoint. Does anyone have an idea about it? I was read about it. Okay, so I guess those are part of the studies would do.
I mean, I don't know about the legal, but here in Ethiopia, so the city administration, especially the two city administration, Addis Ababa and Redwa, they have the legal stand to borrow on their own. So usually they issue municipal bond, but the state-owned banks buys those bonds. So I mean, it's not marketable securities, but at the same time, but like for the others, I mean, the other regional state, they can borrow on their behalf. But from a legality perspective, I don't know. But they don't have that much of exercise, so to speak. And at the same time, it's very hard. I don't know. Maybe you could tell me in Nigeria, because we have a very good similarity in terms of geography and population. Here in Ethiopia, so the state government, the Ministry of Finance, the federal government subsidize 70% of the regional government budget. So I mean, it just tells you. But how would you do it in Nigeria?
Okay, so I think I get the sense of where you're coming from. So let me put a picture of how it works in Nigeria. A lot of the collections are done centrally. So oil is the largest revenue earning for Nigeria. So that goes to a pool, and every month, all of those states, like you have regional states, they meet and divide that amount back to the states. So every month they assemble in the capital and divide whatever accrued from the previous month. So they're going to be sharing in March what accrued in February, because that's the major source of income for the country. And therefore they share back to the states. So the states now have what they use to run their operations. But there is a law that says if you want to raise finance, you do not necessarily have to get the government guarantee in Nigeria. So states actually issue instruments without the government guarantee. But because of the credit strength of those states, because they are all dependent on the national, a number of those states, if they were to issue, they would typically want to go get some guarantee from the sovereign to make it credit worthy to the public. So that's how a lot of those states, but a number of them issue, the very large ones, like Lagos State, they issue without the national government support because they have the credit strength, they have inflows of cash separate from the crude oil receipts that they get. Now, this is Nigeria. Compared to Kenya. In Kenya, there is a law in the constitution. This one I talk about Nigeria was not in the constitution, and it gave options. In Kenya, it's a constitutional requirement that the counties, the 47 of them, if they have to borrow, they have to get an approval from the National Assembly, an approval from the parliament for them to borrow. And what it means is that the debt of that country of that county is technically the debt of national government. Because also they also have a sharing formula being the Federal Republic where all of the income collected is distributed on a quarterly basis to the municipals. You can see, so different countries have a way they've modified theirs. Rwanda, similar to Kenya. So the idea is that most federal republics would have the center being powerful and then share to the sub-regional, just like you mentioned, for Ethiopia. And therefore, there may be linkages in the constitution that I asked. I know we actually have a new constitution of 1994. We need to be sure to check what exactly are the linkages. Are there specific covenants that says those regional states cannot go on their own? If they have to go on their own, they need the national government support. And that will be the convention when you are dealing with state-owned enterprises. Because the legality of it needs to be clear before they can issue those instruments. So I thought to put context that that's how it all goes in practice. Okay, so questions for me?
There's a lot of questions from our online group, which are about like 80 or so. It seems like the ability to sort of type questions instead of raising your hands and ask is becoming more appealing. What I'd like to do is, instead of asking every question or comment, I'd like to contextualize it to the topic that you're covering. But just to go through it, there's one that says, does the rating considers a weight score like FICO? Like, what is the logic in its algorithm? Like, if, but you already mentioned it's a committee that makes it. It's not just an algorithm, like as is typically the case with FICO score. And then there's one comment that says, I differ from the presenter's view of one size not fitting all as we compare weighting and qualitative and quantitative aspect. And this gentleman says, or lady, I think what matters in credit rating is the cash flow likely to be generated by the borrower to service the debt, which ultimately is a quantitative one. And there's also a cost question on how can we determine whether a credit rating agency is independent or not, apart from being required to be independent by model, by IO score, or by the regulator. But what is the way to check if a rating agency is independent? What's the liability for rating agencies if they erroneously give out a rating that results in significant swings on the pricing and value of the security or the issuer that's being rated? In the world, there are many credit rating agencies, but the most popular ones are the three ones. How could we use which ones to use for Ethiopia? And in relation to that is the person saying, supporting the idea of a Pan-African credit rating agency. The only downside is the ability to attract international investors if we were to use a Pan-African. So there's just a lot of questions. I apologize. I'm not going to rattle them all out at once for you, and I'll promise to contextualize it to the slides that you're presenting on.
Okay, thank you, Fasil. I mean, fantastic questions. I mean, which shows they're also following in this conversation. And I'll try and tackle the ones you provided. We had mentioned earlier that beyond our model, which captures the AI, all of those issues, there is a committee. There's the human to review. And I mean, we mentioned garbage into the computer, garbage out, but it doesn't clearly. So therefore, the committee has to sit. However, those models are also recalibrated, and models are also tweaked based on the context of the country, context of the industry. So that's one of the things we'll be speaking about, that these models are not one size for every country. No, because we need to be equitable. We need to have equity. I mean, we're not saying equality. We're not using the same method. We're not doing equality. We're doing equity. Where are you today in your macro development, your macro growth? That's how we're going to use to benchmark it. But everyone within that space will benchmark under that same macro. So any company in Ethiopia will benchmark under the Ethiopian macro. If you now decide you want to issue instruments outside of the market, attracting for it, will benchmark you against the global parameters because you are playing in the global space. So the idea is that, yes, we use all of those, but there is the committees who now eventually sit and discuss. In terms of defining, I mean, I think the participant had mentioned he is tilted more to the quantitative. because focus on cash flow. I mean, and I've said cash flow is good, but you can have cash and not be willing to pay. Willingness is also important, which is your character. So you can have the billions in your account. I decide not to pay. What can they do? I mean, there's legal ways out to go prosecute, go enforce, but willingness is a key consideration in credit appraisal. You must be, which is why you always say when you get into deals, you have a willing buyer and a willing seller that have capacity. There must be willingness. There must be capacity. So you can't take either of. What happens is the degree, depending on the kind of counterparty you're dealing with, that matters. What do we place more emphasis on? If I'm dealing with a retail investor, I place more emphasis on character. I'm dealing with a corporate entity, I place more emphasis on quantitative and less emphasis. So that's the rationale around the methodology. The question around the independence of credit rating, which is why there is a licensing process where you need to provide sufficient information to the regulators to give them comfort that the agency that has been licensed, the players, the partners, and also the committee members have the requisite knowledge and they have subscribed to all of the tenets of the code of conduct. Same way with the IOSCO conduct I mentioned, that is the global body. In terms of liability, one of the strange things is rating agencies typically have what we call professional indemnity. So you go to an insurance company, take up what we call a professional indemnity. We do not expect or do not anticipate that there'll be errors or there'll be mistakes. But when they occur, what are our fallback? So rating agencies at Augusto and Co, we have a professional indemnity for all our insurances across Africa, with a registered insurance company that has operations in a lot of countries in Africa, such that if we have issued any wrong rating, which we haven't till date, in any country and there's a liability, our professional indemnity kicks in. And that also means the insurance company providing us with that underwriting scenario has capacity to meet those claims on our behalf. And it's so important for the work we do as rating agencies, because sometimes we face these issues that some of the information provided to us by the clients may have been compromised. We see this in practice, compromised. And therefore, if you use a compromised information, you get a compromised outcome. And therefore, we have this liability to check all of those excesses. So yes, we have professional indemnity from a liability standpoint. In terms of affiliation with the top rating agencies and which of them should we use, none is better than the other. They all started around the same time. They've all developed and grown. They all have research as part of their components that lead in their rating appraisals. Same with the Pan-African ones. And I mentioned there are a few of them in Africa. It's not just Augusto. There is GCR, there is DataPro, there is Bloomfield, there's Wara, but they are not a lot. The idea is also not to keep the numbers large. Regulators will typically not keep the numbers of rating agencies large. There is Sovereign in South Africa, Sovereign rating agencies. There is Beacon in Ghana. The idea is in each country, in each region, you have about 3, maximum of 5. And more often than not, it is the same agencies that replicate themselves across these markets, because it's also a specialized skill set. When I begin to talk about their parameters, you realize it's quite a specialized skill set. It's different from accounting. It's different from credit because it's a risk appraiser. And when you go to the universities, they don't teach you risk appraisals. You learn risk appraisals because risk changes. And it's a function of your research. So there are a lot of moving parts. So which is why you can't say anyone was born a rating analyst. You were not born a rating analyst. You were grown and developed and taught the method to it. So I just thought to put context to all of this so that you understand that as we continue to have this conversation, there'll be more questions. And we are ready, we're happy for those questions, because that shows you're engaging, you're trying to get the meat of this conversation. Because we think Ethiopia is long overdue for rating agency, long overdue for our market development, and that's why we are here. That's why we're having this particular session. And we're going to have more sessions to ensure that everyone gets a good understanding of it and therefore be able to properly position ourselves for the future. So having spoken about issuer and issue credit rating, one focusing on the entity, one focusing on the instrument, we'll now go to the forms in what ways does these ratings manifest? We talked about the types, but now we're going to the forms. How does it manifest? So what we've done is to put a bucket list of all of the potential types of entities you can do ratings for. So you hear sovereign ratings. Those are ratings for sovereign countries. Countries that are independent, you rate them. They are called sovereign ratings. You have ratings for banks, commercial banks, merchant banks, development banks, universal banks. In different climes, they are called different names, and they have multiple types of banks that operate under the banking industry. So there is rating for banks. Now, all of these forms means the methodologies will be different. The approach will be different because they do not all behave, act, operate the same way. Meaning the parameters for sovereign will be different because we're looking at the national, fiscal policy, monetary policy, exchange rates, safety, property, safety of life and property, household incomes, exchange rates, reserves. Those are issues you're looking under the sovereign. Different from what you look at a bank. At the bank level, you're looking at, are they providing value for shareholders in terms of profitability? Are they meeting the statutory requirements from a liquidity ratio standpoint, from a capital adequacy standpoint, from a risk management, from an NPL standpoint? Issues. So methodologies are different. Beyond the banks, you look at what we call the insurance companies, a different kettle of fish. Then the financial services, but a different kettle of fish. For them, do they have capacity to pay claims? What is their underwriting capacity? What are the risks in terms of their risk management structures? Have they factored in climate-related risk into their assessment? Because it's becoming a big issue. An insurance company underwrites a particular transaction and climate change happens. Drought, flood. I know they have those fine prints that says any acts of God are exempted, omitted, are not covered under these policies. But no insurance companies have been taken to court because those acts were not premeditated, they were not preempted. Nobody thought about them. So which is where the conversations around ESG will come around tomorrow. That should we really be thinking about those risks, climate-related risks? They are real. They are here to stay. And it's not because we've done anything. Also, sometimes because we've done some things, we've not also protected our environment properly. How have we disposed our waste? Are our drainages, are they flooded with our plastic bottles, PET bottles? Are we utilizing God-given renewable energy, solar and wind? Or are we using fossil fuel that takes CO2 into the environment and therefore reduces our life expectancy from a health standpoint? Issues. I mean, we'll unpack all of those issues tomorrow under our green, social, and social. But those are issues that you see under the insurance appraisals because of risk. Beyond the insurance appraisals, you go to what we call the other non-bank financial institutions, our asset managers, our pension funds. They sit on our pensions to pay us in future. What are they using the funds to do today? What kind of assets classes are they investing those funds to prepare for the future? Are they investing it in outlets that have been credit rated? Themselves, do they have credit capacity to attract pensions from us, capacity to attract capital? Conversations. So the rating appraisal for those kind of institutions are also different. What you look at is also different. Are they meeting regulatory requirements? Because they also belong to regulation. Some of them are licensed, regulated by the National Bank or by some other pseudo regulatory agencies. Are they also meeting those statutory requirements? That's another form of rating. Beyond that, you look at the multilateral financial institutions, the MFIs, who operate in that ecosystem. The DFIs, the development financial institutions, who are providing credit, lines of credit, advances. They also have methodologies to rate them. Those who are focused on agriculture, those who are focused on real estate, housing, those who have, all of them, they all have methodology. So you begin to see that you can't take one methodology and say, let me copy and paste. So what it means is that at a rating agency, you're going to have several methodologies. Before you start an assessment, you need to know what type of company is this, where do they belong to, and therefore I can begin to apply the methodology in the appraisal of quantitative and qualitative. Beyond the development institutions, we have the development credit guarantee institutions. I mean, one of them has been set up in East Africa called Damana. Damana is a credit guarantee company set up in Kenya, but focus is for East Africa to provide credit guarantee for East African operations and entities. They're getting financing from AFDB, Garantco, Cardono, as seed capital to start up their providing guarantees. They also get rated because they also be providing lines of credit. So the idea is that each of these buckets of, I don't want to call them industry, peculiar type of organization have their own peculiar methodologies that are skewed both in the quantitative and qualitative. Beyond that, we now go to the corporates, those playing in the real sector, those who are providing goods and services. Call it real estate, call it technology, call it trade, whatever name you call it. Once you are exchanging value for value, either in terms of goods or services, you are in the real sector. You're not providing loans, you're not providing credits, you're in the real sector. You're buying, selling. You have counterparties you deal with. Counterparties who want to invest in you also want to understand your own credit strengths. And therefore, we have parameters for that. And finally, we have the last bucket, which is now the municipal, the subnational. That's the general term for it, subnational, because it's below the national. In other countries, in Nigeria, it's called states. In Kenya, it's called counties. In Rwanda, it's called districts. Here in Ethiopia, it's called regional states. Different name across different countries, but they're called subnationals. Subnationals, depending on how that country has been structured, is it unilateral, is it federal, what structure will determine what kind of approach and methodology that will be applied to the appraisal. So this is how ratings typically would manifest themselves. And it can manifest either as an issuer rating or as an instrument rating. Are we still together? Yes, sir.
I was wondering, what the impact of sovereign rating would be on our entity ratings.
Okay, good.
In other words, can an entity get a higher rate than the sovereign rating?
Well, that's a good question. I mean, we call it sovereign ceiling, and he's going to speak more about that. But there's one part that you touched on, which I opened the earlier conversation this morning by saying, how do we compare a country like Ethiopia with a developed nation? You just touched it. It's not a one size fits all, which I understand. But how is it possible for a sovereign and a frontier market to ever get a higher rating? I'll give you an example. Countries like Estonia, Eastern Europe, their cost of funding from multilateral development agencies is about 0.5%. Some countries have got 1%, whereas countries in Africa pay up to 10%. So think of it. You're buying anything of value in a market and you're being asked to pay more, while others are paying far less. A country like Ethiopia with, a big market, 120 million people and counting, coming out of some difficulties, but in a solid growth ground and map, we could end up getting a rating that would allow us to pay so many times more than what a small country in Eastern Europe could pay for. So what is it that this methodology that you're talking about, it's not one size fits all. I'm not asking you to answer for Fitch or Standard & Poor or Moody's, but we'd like to understand how that works in why what we're paying for is so much more than what others pay for.
And I'll try and answer it politically to be politically correct with that answer. Just so in case I don't answer it, I've told you I'm going to answer it politically correct. So ratings are dependent on quantitative and qualitative. Quantitative are the numbers. Numbers don't speak. People speak about the numbers. Then there's also the qualitative, which sometimes can border on perception. Which is why I've mentioned that sometimes I think the Director General mentioned it clearly in the morning, perceived risk. That's what they call perceived risk. It's a key concern in rating perceived risk than the actual risk, which is that sometimes there's always an encouragement that perception is not always reality. You need to be on ground to see the reality. I mean, perceived. So that is the reason why sometimes the perception of the West and those in Europe may have a better perception from where they sit, where the judge sits. Decide who the judge is, where that judge sits, and make that decision. Perception about Africa. Africa has been declared as the dark continent, the frontier continent, the emerging market. Sometimes we think our growth rates are even higher than what's happening in those places. Ethiopia is growing at an average of over 5% for the last 3 to 4 years, despite COVID. Some countries in Africa are growing at 7, 8%. What are their growth rates there? We have the resources, manpower, human resources, natural resources, but yet perception. Risk is both quantitative and qualitative. Quantitative, your numbers. Can you defend your numbers? Again, the fact that we do not also put up these numbers promptly, quickly, and sometimes we cannot explain the numbers we have. I mean, I'm trying to be politically correct. We can't explain some of these numbers we have. I deal with a lot of Africa. We can't explain some of the numbers we have. And we've not done complete due research to validate some of those numbers. Our statistics shows up sometimes on inflation, on growth rates, and we can't validate, you can't really how much, what is the sample size that we used for such assessments? There are issues. So I'm just saying, but regardless, that is what influences the risk outcome. And people depend on these ratings to make their decisions. So once you've been perceived to be high risk, it means your premium will be what? Higher. So which is why you see an Ethiopia would have a higher rate. Kenya recently issued a $1.5 billion Eurobond at about 10.37%. The previous one was about 7%.
Yeah.
But now let me juxtapose this. Benin Republic issued 2 months before that at 7%. Go and check the records. Benin is an African country. Yes. 7%. 7. I'm just saying, so there's also what they call perception risk. So, I mean, I can't judge, but I'm saying there's a lot that goes into the appraisal assessment. Do they see you as being open? Do they see you as being ready to do business? I mean, what's your ease of doing business? What's your Transparency International ranking in terms of corruption? There's a lot of issues that gets into which is a qualitative issue. So I'm saying there's the qualitative, there's the perception. There's also where are they, what do they understand of that environment, which is why, I mean, part of the work we've done with ECA and APRM, because we belong to the African Peer Review Mechanism, is to promote an African-based rating agency where we understand the problems, we know our local solutions that are globally relevant. And that's what we are pushing. That's the narrative we're pushing. That we can't expect you to tell us our problems. We know our problems. And we understand the dynamics, so therefore we can solve these problems. And we have the capital to finance most of our problems too. It's strange. Africa has huge capital. It's just that we're not completely interconnected. The day we get interconnected as Africa, we don't need, I agree this is a record, we don't need a lot of foreign financing to develop ourselves internally. We have this capital. I can tell you confidently, across the top 5 countries in Africa, Egypt, Algeria, Nigeria, Ethiopia, South Africa, we have this capital available. Go look at the Forbes list. It shows the capital exists. It shows this is possible. So I'm only saying we need to develop homegrown solution for our homegrown problems and not completely put our destinies in the hands of others. I try to pause there so that I don't get too politically correct with my emotions. But let me answer your question, sir, on can an entity get a credit rating higher than the sovereign rating? Big question, and I'll answer you with 2 ways. Prior to 2 years ago, we thought it was impossible to get a rating better than the sovereign or at par with the sovereign. But the case of Ghana and its default has taught the rating agencies a new lesson. Ghana defaulted not just on international obligation, also on domestic obligation. I know it hurts the most when you default on a domestic obligation because we expect you to be printing of money, we expect you to have capacity to repay your local currency. I mean, we don't expect Ethiopia to default on the Ethiopian birr. What's the word I will do? We ask the printing to print and get, but Ghana defaulted on its local obligations. And that creates some perspective around really sovereign risk? Can it really be the ceiling for everyone in that? Also, what borders on that is the kind of foreign exchange control system you have. Because some companies locally who get receipts outside of the country with stronger currencies can actually have a better rating than the sovereign, because their receipts in that counter currency, if being converted to the local currency with full rooms, I mean, so you begin to see the picture that those conversations are current, are genuine. I mean, so we no longer take a posture like we used to before, that sovereign is the best and every other person is below it. We are learning lessons, hard lessons in the last 2 to 3 years, that sovereign may not necessarily have the best credit quality, but they have liquidity. So, I mean, I'll pass it there so that you can think about it, because it's a thought process. It's something to think about. Do sovereigns have the best ratings? Depends on how you see it. Rating agencies have said no, and you can argue, we can contest it, we can put our points down, but it's happening in reality. Yes, sir, I can see your hand is up.
So just to continue Asfa's question, because recently I think 3 of them downgraded the American government to, I think, AA, right? But some of Coca-Cola's corporate bond is AAA, right? So would you say that this is a perception that because of the political wrangling of Democrats and Republicans over the debt ceiling, is that a perception risk? Would you say that? Because America cannot run out of dollars, right? And one follow-up question. I think I really want to understand this in African context. So if you see the whole international economy, international finance, so all the dollars circulate, majorly speaking, Citi, Commerce, Deutsche, JP balance sheet, right? Africa's debt settlement, remittance, you name it. And then Africa, like, at least for all this transaction, inter-Africa trade, we pay around $5 billion, which is a waste, but okay, we'll come to that. So is there any way that you split and rate the country's obligation based on the currency type? Is there a way to do that? Because those 2 things are very much important, especially right now with the Russia-Ukraine war. What the Russian had to go through, because the U.S. government literally confiscated like $400 billion out of their reserve in the American financial system. So, is there a way to differentiate it, and so that you could put your risk, like for the corporate, for the banks? Is there a way to differentiate it?
I think Ike is getting more than he bargained for, and I'm glad that you're holding him to answer. In as much as he can, he will answer it in a politically correct way as he possibly can. I think following that question and Ike's response, I would like to invite Thomas Gengitae from Ethiopian Airlines to chime in and share with us like how Ethiopian Airlines has managed to maintain a credit rating, allowing him to put in massive equipment orders from Boeing and Airbus and continue to do so at reasonably affordable credit rates. And I think that kind of experience sharing would be important. And at some point, hopefully, our businesses grow strong enough and integrate regionally to diversify operations and in source of income, as well as be able to compete internationally to be able to get a high rating that's not being sovereign bound. So with that, I'll stop here and allow Ike to respond, and then follow on with Thomas Gunn to Thomas Gunn. You want to go ahead first?
Okay, thank you, Fasil. Let me start from Mr. Asfa's question, whether a company can be rated to be higher than the sovereign rating. I think that is possible in two scenarios. If the corporate is a government-owned enterprise, and if it is rated by Moody or Standard & Poor or Fitch, it's not possible to get a higher rate than the sovereign rate. But if it's a private company, there is a possibility that the company can get higher rate, but mind you, credit rating takes a number of factors into account. So one of the factors that will be considered for a private company is it will be considered the environment where that private company is operating. Let's say Dashen Bank. Now, if Dashen Bank would like to be rated by Moody or Standard & Poor, Dashen Bank is operating in Ethiopia. The fact that Ethiopia as a sovereign country has low rate will be factored in the rating with Dashen Bank. But if Dashen Bank has other variables, other excellent operational and strategic matters, that will wait and will get better rate. But for corporate companies like Ethiopian Airlines, which is 100% owned by the government of Ethiopia, if it's rated by Moody, it's unlikely that will get better rates than Ethiopia. But fortunately, we are not rated by these three companies, Moody or Fitch. So we are rated by export credit agencies, which we call ECS, like Exim Bank of the US, Exim Bank of China, Export Development Bank of Canada, UKF of England. So we are rated by these companies because we are importing their products. In the case of America, in the case of Exim Bank US, we are importing Boeing products. And American banks such as Citibank, JP Morgan, ING Bank, they are offering credit facility to Ethiopian Airlines for the purchase of Boeing products. And these banks would like to have guarantee. And the guarantee is usually given by Exim Bank of US. So what is rating Ethiopian Airlines is Exim Bank of US. But Exim Bank, when it rates Ethiopian Airlines, it considers a number of variables. They call it EIC. They look the environment first, the geopolitics, the macroeconomics outlook, and other factors. Then they will go down to the industry, the competition, the regulation, the technology impact, and they will go down to the company, specifically to Ethiopian Airlines, and they look at a lot of variables. They evaluate the profile of the management, they evaluate the track record of Ethiopian Airlines, they evaluate our projections and forecasting for the next 5 to 10 years. And when they consider overall variables, we usually get second rating. The first rating, we don't like it to get it because it has a limitation on the amount of borrowing or facilities that we are going to buy our aircraft. So we usually land at the second rating. They call it BB plus or triple B.
for that question and answer. I would like to just paint a small picture and then let us open up for questions that will go for lunch. And just to give some context to his conversation around securitization, I used to head our securitization at Augusto and Co. Asset-backed, CLOs, CDOs, they all have different names, mortgage-backed securities. It's a very complicated risk assessment process. It's not what we are speaking about. What we're speaking about is the plain vanilla, like we call it, the direct on-balance sheet. And securitizations are off-balance sheets. It brings a different kettle of fish entirely. There is still some element of qualitative, but very reduced, at a reduced proportion, because we are now after the fact that there is some receipts, there is some trustees, there is some other parties who have several roles to do in that transaction. So for the purpose of this particular session, we've removed securitization because you need to first of all understand A before you get to D. That is a higher level for, so I will chip in on it a few times, but the focus will be on the plain ones. If we get the plain ones, then we can begin to get into the complicated structure. So yes, Fasil, before you get them confused on securitizations, let's learn the plain ones first, then we'll build on that. Remember, we said this is going to be a series of sessions we're going to be having. We can come back and talk about the securitizations, the ABS, the mortgage backs, the cards. But I just want to talk about one thing before we go for lunch. The philosophy and approach. And Pradeep will help me with the next slide, the philosophy and approach to credit rating. I mean, this just re-echoes what my friend from Ethiopian Airlines had mentioned. Globally, the approach for rating is to do what we call the macro to micro approach, meaning it does not make sense to assess a company in isolation. Companies do not operate on their own and in a vacuum. Companies operate as part of a wider environment. And therefore, we start with the macro environment, which is at the sovereign level. What are the risks at the macro environment? Political, economic. You also assess the country's policies, the country's structure, unemployment, taxes, all of those issues are placed under the macro analysis. Now, this brings me to our conversation around sovereign ratings. When we do sovereign ratings, we rate macro of that country, which is where we're able to assign ratings to the macro environment, which is to those countries. Now, that becomes part of the indicators that you would use eventually to assign the credit risk rating to that entity or the instrument. So we start with the macro first. So we also believe at Augusto and Co that if you're to do any appraisal, you must understand the country you're playing in, which is why, for the purpose of coming to this particular session, we have to do our own research on Ethiopia, macro environment, where we're on the debt sustainability work, fiscal policy, politics. It's important because you need to put it in context. So first of all, you do the macro analysis. That's the philosophy of credit rating. However, disclaimer, a few rating agencies find this very cumbersome to do because it's a lot of work. Macro analysis, the things you consider are a lot. But because of that, a few agencies find it difficult to do this and they find it cumbersome and they do not actually do good credit assessment at the macro, which can now have impact on the final outcome. So beyond the macro, you now come to the industry. The industry is, where is this particular company I am trying to appraise in? What are the peculiarities of that industry? How is that industry structured? Is it oligopolistic? Is it a perfect competition? Is it monopolistic? What is the structure? What are the rules? What are the regulations? Why do we do this? Companies belong to an industry, whether they are regulated formally or unregulated. Companies are registered, and there are certain statutory requirements that they need to keep, be it banks, non-banks, real companies. And therefore, you must understand the industry they operate in. Are they going to be changing regulations, changing policies? And these changing policies could be from the national decrease. If today the government of Ethiopia increases our tax rates, it affects everybody. So a macro issue can affect a company, can affect an industry. If at the industry level we make some proposition to government and we want to perhaps add some additional levies, or want to reduce, or want to open up for foreign competition, all of those have impact on businesses. So therefore, you have to look at macro analysis, then you go to industry, and each of these have their own tools and their own methodology. And I'll just give you a sneak peek into it. For the macro analysis, you want to do what we call we want to do what we call country risk analysis that focuses on the politics, the economy. Under the economy, you look at exchange rate, inflation, unemployment, you look at your reserves, you look at your import cover, a lot of issues. You come to the industry, you do what we call the pest tool analysis. I'm sure you've heard about pest tool analysis, where you look at the political environment, social, technological, legal. You look at, beyond that, you look at the Porter's 5 forces, where Michael Porter talked about competition, rivalry, and barriers to entry, a lot of issues. Each of those have their own analysis to do, separate from the company analysis that we talk about, the financial and non-financial. Then you now come to the company analysis, where you now dissect quantitative and qualitative. Those appraisals you've done previously will feed into that analysis, either from the quantitative or the qualitative, before you now bespoke it to the specific company analysis. Then you take it through the scoring model, recommendation, and the rating committee. Now, this is what we call the philosophy of rating globally. However, like I mentioned, not all rating agencies adopt this model because of the work involved in the first two. You must be a research-focused rating agency to do all of this. If you're not research-focused, how will you research and know what's happening in the macro, what's happening at the entity, and its costs? It's expensive because there are costs involved in doing those research. Research is not cheap also. Research is not getting 2 figures online and gives you, no, research is expensive. So think about, you don't research at the macro, you don't research at the industry, and because there are various industries, meaning you have to keep tab on, so you now have to have what we call industry specialists. So typically at Augusto & Co would have individuals who are specialists in different industries. I mean, Christine has a specialty in fintech, has a specialty in renewable energy, others have specialty in insurance, because she can't have a specialty across the whole industries. Even you, the leader, you'll have your own specialties in several areas, but you have an idea of what happens across. That's the idea, because that research component fits into the analysis of the company. Is the company performing well? Yes or no? Depends on what's happening in the industry. Who are the competition? What are they doing? What's the industry averages? So meaning we typically run out industry analysis every year. And in some instances, it can be more than a year if there are a lot of changes in that particular industry. You're beginning to see the extent of analysis that goes in from a research standpoint before you get into the technical point. So I just thought to share this philosophy, as this is the guiding conversation. So for thinking about rating agencies, they must have a very strong hold on research, strong hold on the technical research across those segments before you get into the company analysis. And I guess I'd want to just hang it there so that when we come back from lunch, we can now dive into the parameters. What parameters do we look at under this? And our focus for this session will be, we'll go straight to the company. We will have left out the macro and the industry. So we're going to focus more on the company itself. But there are bespoke sessions for macro industry analysis alone. 1 day, 2 day sessions to just discuss macro issues because they are huge. Industry issues, you pick the industry, which is what I mentioned there, that you can have specific sessions maybe for the banking industry. We now have what exactly do we look at? So we'll look at all of that, but I mean, the focus will be on the company. And we've chosen 2 groups of companies. There were over 10 groups: sovereign, banks, insurance, microfinance, non-bank insurance, asset managers, DFIs, corporates. We've chosen 2 groups to analyze as part of our conversation today. The 2 groups are the banks, because we know banks are predominantly very strong and also very influential here in Ethiopia, and also the corporates. Those are the 2 we'll be x-raying deeper as we come back from lunch. Questions before we go for lunch? Thank you.
Do you really want to ask questions or you want to head to lunch? Thank you, AK. Really appreciate you answering most of our questions politically or being politically correct. And thank you all for your participation. I'd also like to thank and recognize Sonia Somaje, Chief Innovative Finance and Capital Markets of the UN ECA, for allowing us to use the facility, including our lunch. We will come back from lunch in exactly an hour from now, if I'm not mistaken. And if you have any questions, please hold it. And then we'll start off with your questions on the afternoon session. We're likely going to be going fast for the afternoon because we're kind of delayed a little bit. And I'm sure EK will have a lot more to cover for the rest of the day. Most of you, or some of you that have been attending online, we were disconnected for a little bit and we may have lost some of your questions. So if we're not responding to them, please do feel free to shoot it back to us. So with that, it's a lunchtime. Welcome back from lunch. I hope you had a great lunch. We intentionally wanted to make it a bit heavy so that you could doze off while AK goes on a cruise mode. He has quite a ground to cover for the rest of the afternoon. Maybe I'll give you two choices. Either you commit to stay until 7 p.m. this evening, or you could hold off your questions or boil them down to the very essentials. It's up to you, really. AK said, please hold them for me until 7 p.m. I'm so energetic. I'd like to keep going, and either I honor his request or you honor your request to leave early. It's up to you. So I think with that, we're gonna get started. A lot has been raised. I don't want to repeat them, and I hope EK has taken some notes. I'll just allow him to take it away from here. EK.
Thank you all for coming back after lunch. It's tricky when you go for lunch, but to see your faces back and smiling, I'm excited. And the energy I get is from the room and from those online too. That's the energy we get to continue to speak on these issues. So I guess we want to just dive into it. Just to do a quick 1 minute recap of what things we've spoken about today. We started by talking about the history of rating. Where did it all start from the railroad, from the merchants and the customers, and the fact that trust was an issue, and someone needed to bridge that trust gap. Rating agencies got a job to do, and the job became critical on 3 pillars: independence, reliability, and also on integrity. We moved beyond that to say, okay, what exactly is credit rating? And we spoke about the fact that 2 keywords you need to take back home is an independent opinion and it assesses credit worthiness. I will try to demystify those 2 keywords, which I won't go into details now about. Then we went to talk about what types of ratings exist. And we mentioned that in the universe of ratings, there are 2. Either you're doing an issuer rating or you're doing an issue rating. Either you're rating the entity or you're rating the instrument. Either you're rating the company or you're rating the transaction. And in rating the transaction, you'd have to understand who exactly is the issuer before you rate the transaction. An instrument must have an issuer. So meaning the starting point of every rating is typically the issuer rating. Then it can now metamorphose into. Then we went further to talk about the various forms of rating. The ratings can come in different forms. It's manifested in 2 types, but it can have different forms. We mentioned the forms to be the sovereign ratings, the municipal ratings. We also mentioned the forms to be the bank ratings, the insurance companies, the asset managers, the non-bank financial institutions, the corporate entities, the DFIs, the MFIs, multilateral funds. The whole idea around it is that why do we have to put them into buckets? They all have peculiar roles and functions in the market, in the ecosystem, and therefore you can't use one methodology for all types of companies. Different purposes, serving different needs, different structure. And therefore you now have to develop different methodologies that are aligned. And in trying to develop these methodologies, you now have to have a guiding philosophy. What guides your approach to this methodology? I will start by talking about the fact that it's the macro to micro, where you start from the macro, trying to appraise the macro environment because operations in that particular country, no company or entity is insulated from activities in that country. And I give an example of exchange rates, foreign exchange issues. No one is insulated. Now drive beyond the macro, come down to the industry because there are industry peculiarities. Is it monopolistic or oligopolistic? I give some tools you can use to actually measure the industry strength and that. Then you dive into the company analysis. Then you go through all of the whole quantitative and qualitative assessments to get to your rating, scoring, and your committee. So that's where we left off before break. But we have so much ground to cover. But I also like the energy of asking questions because it enables us to understand it better. And just like Fasil had mentioned, I'm happy to stay here longer, as long as we want. I'm happy to, don't be worried about me, I'm happy to, to stay here longer. It's something I enjoy doing, so I'm happy to do it for longer. But I also want us to focus on the key issues, the key things. We can't learn everything in rating in one day. So this is why we call it a master class. The key things you need to go home with, the things that you need to take up, we'll share them. Other ones that we think are not significantly important, but are important in the scheme of things, we'll talk about them. But please keep your questions coming. Don't relent. I'll take pauses to take your questions, take your reactions, where we have those significant issues that we think are of importance. So I just thought to mention. Yes, so we move forward in terms of the next. We want to talk about I think just tap to touch the screen. Okay, we want to talk about the process. I mean, someone asked early in the morning that the expectation is around the process. What happens in the process? So let me just give you a notion of the process. It starts with an engagement, meaning you need to engage the rating agency to carry out an assessment for you. Is what we call a solicited rating. So there are two types or two ways of engaging rating agencies. What they call solicited rating and unsolicited rating. Solicited rating means I come and request for a rating because I want you to appraise all my instruments. Unsolicited is I as a rating agency do not need your consent because you have public information and I go ahead and use that information to provide an opinion. But that opinion is not a full reflection of it because I have not had engagement directly with you. So some of the case studies we will be showing you today are unsolicited because we did not engage with those counterparties to really understand. So therefore, some of the information we're putting out there, caveats, there could be more to it because there are usually facts behind figures. Figures don't speak, but we've used figures based on our experience. I just wanted to put that caveat. So the rating process starts with an engagement. That engagement also details what we call the non-disclosure, because you're going to be giving us access to your systems, access to information that may not be publicly available. And even if you're a public company, some of this information may not be publicly available because your strategy may not be out there in the open. And therefore, you have to give us access to that information. So therefore, you need to sign a non-disclosure agreement saying that the information you provide to us will be kept confidential and therefore will not pass it across to a third party that they could use for their own benefits. And which is also a very strange reason why rating agencies typically, people who work in rating agencies do not typically do a lot of investment because we have inside information about some of the operations we do. Again, but there's a threshold for materiality. If I'm to invest in a company, for it to matter in the scheme of things, I need to invest, I need to have holdings of up to about 5%. So when I have very significant amounts, the codes which we belong to allows us to have very minimal or invest through schemes. Someone asked questions around safeguards. Those are also safeguards because the rating agency knows what's happening, can predict, and therefore should they be allowed to invest? Maybe yes, maybe no, but they all play in the same space, so therefore they should get value. But they shouldn't skew the interest and investment of people into a particular entity because they're investing. So that aside, we talk about the engagement process. After you've sent the engagement agreements have been reached, commercials have been agreed. I mean, someone asked us a question during lunch. Safeguards, commercials are paid up front before the exercise starts because of independence. Because if you pay the commercials at the end, it means that if the outcome is not favorable to you, you can choose not to pay. So it's a funny scenario. You pay for a service you have not received. Think about it. You pay for a service you have not received upfront. And it sounds strange, but it's to protect the integrity and independence of the assignment. Because if the payment is made or the commercial is paid at the end, then it becomes a success fee. That means the agency has to ensure that you become successful for they're going to be paid. So it's a global phenomenon, it's a global practice, and it's a standard globally. That services for rating agencies are paid upfront. There are like some professional parties are paid upfront before they start the exercise, just to maintain independence. So it's one of those shocks you'd see when you get into ratings. Why do I have to pay you thousands of dollars ahead of the assignment when I don't know the outcome? So it's not necessarily a consulting assignment that at the end of the consulting report, I give you and you say you don't like it. No, it's an assessment that's done, which is why it's regulatory driven, which is why you can't have too many players being licensed to provide that kind of service. Because there's also the risk that the rating agency may not perform on the obligation. But because they are licensee of a capital market operator, they must live up to the expectations. So you begin to see how it's becoming a little bit different in terms of your typical everyday activity or everyday businesses you do. Once the engagement has been sorted, the next will be a questionnaire modeled according to that industry where you play, specific questions around the operations, the industry you play, and the activities that you carry out as an entity. What is that supposed to do? That's supposed to obtain information relevant for the exercise. Information would include your financial statements, your policies, your corporate governance policies, your board charters, your credit policies, your risk management, a whole lot of policies, information provided. Once that has been provided to the team would undertake what we call a preliminary analysis. They review the numbers, review the information provided, and then next process to set up a meeting with key management personnel to understand facts behind the figures and the different departments, critical stakeholders in that particular. So, for example, a corporate entity, you set up meetings with the senior management, with heads of operation, the head of credit, head of technology, legal, human resources. All of these heads of departments have a role to play in the success of that business. So, therefore, you set meetings with them. Beyond the meetings, you have physical visits to do what we call site visits, site demonstrations, technology demonstrations. If it's a credit lending institution, they take you through onboarding the customers, granting the facilities up onto the repayment process. What goes into that whole structure? The same way for a production outfit, we visit the factories. Is there really a factory? Is there really a manufacturing outfit that exists for this company? We take a sample of the locations and visit a few. Have a conversation with the people on ground because of social issues. Then at the end of that engagement, the team goes back, prepares a report on the findings, quantitative and qualitative findings through all of these whole engagements that have happened with the visits, both the technology side of it, the HR side of it, and prepares a report. That report would contain insights and findings and comparing you with the industry averages and also in the context of the macro. But that particular report will typically not have a rating at that point. It is for you, the entity, to review and provide what we call opinions on factual information that's been provided. Are there errors in the factual information presented, or are there disagreements in opinions? Why is this so? If we provide you a rating with a report, your focus will be on the rating. You will see everything in the lenses of the rating. And therefore, you may actually accept the whole report the way it is or reject it because of the rating. So we give you an opportunity to scrutinize the output, which is called a draft report. Once you're done with the draft report, you send your comments, you review your comments with another stakeholder engagement session, review your comments, we incorporate the comments. The next process is to now share the comments, plus the analysis finding, plus the proprietary rating model to the rating committee members. Independently, they now sit, have a period of time, maybe 3 days to 1 week, to sit and review. And if they have a need, they engage with the analysts. If they think they want more information, they can request to set up a meeting with the clients so that they can engage at that level. And then they provide the opinions. Once they provide the opinions on the rating outcome, we ensure we get uniform or unanimous decision. If it's a split decision, we look at going with the majority. You will never have a tie break because we typically have odd numbers. So you won't have a tie break where you have 2 on each side. It is usually odd numbers. So you have one majority against the minority. And on the back of that, you can now communicate. Now, those rating committees, whatever their decisions have been, also documented and filed for the purposes of posterity, in case there are issues to go back to uncover what had happened, so that everyone has somewhat what was the rationale behind their decisions. Then the rating becomes made available to the client or the instrument for the issuance of the transaction. Then we begin to now request for, do you want it to be published publicly or privately? We typically give that opportunity. You want it public? You make public announcement about it. You want it private? You want perhaps it's not where you think you want to be, or you expect to improve in the future. You want to give it a private rating, it's fine. Private rating is acceptable, public rating is acceptable. You make the choice at that point in time, because we don't want you to make the choice at the beginning because the outcome is not known. And you may believe that the outcome may influence perception negatively or positively. It's all up to you. And then we now host those reports on our websites, make publications in newspapers or whatever medium we agree as the most. So typically, a rating process for an entity that is starting to get rating for the first time will take about 5 to 6 weeks. 5 to 6 weeks. For an entity that has been doing it consistently, has already a repertoire of information base where they can provide those information, it could take anywhere between 3 to 4 weeks. Again, this timeline can extend beyond 5 to 6 weeks because the level of details that are required I mean, imagine having about 150 questions you need to respond to. And out of those 150 questions, over half of them require you to attach supporting documentation that may not be readily available and in a particular format or in a particular way you want it to be. So there's some work that needs to be done. So it could take you sometimes, for some first-time written age clients, it could take 2 months. Others, it could take less if they've already gone through some independent scrutinies in the past. But usually around 4, 5, 6 weeks is what we see in practice in terms of the process. So this is, in a nutshell, the process. And this process is a standardized process across most. The part that is not standardized across is the fact that not all rating agencies do visits. They don't do visits. Some of them, maybe because of location, because they don't do visits. But the standard practice is to do visits. Visits so that you can actually validate all of the information that's been shared with you and then be able to now put it in context. So that's important in terms of the rating process. Let's move forward into the methodology we now use at Augusto & Co. I'm trying to now drive it back home because on the back of this methodology, we'll now go into the criteria. So Augusto & Co. has adopted the philosophy of macro to micro, where we start with the macro analysis. We focus now on the industry specific, then on the company, then to do scoring. So we've adopted the universal approach, which is what we do, because we have a very strong research team that supports all of our analysis across countries and across industries. On the back of our methodology, we call it the top-down approach at Augusto & Co., meaning we start from the top, go to the down. The general name is called the macro to macro, but we call it the top-down approach. We start from the top and come down. We don't start from the down upwards, no. We let it trickle down. We do your macro analysis first. What is the risk rating? What are the risks that exist? We come down to the industry, do our assessments. What are the risks and the risk rating? Then we come down to the country, to the company risk or the company itself. And in that company analysis, a proportion of the weights will now be assigned to both the country and the industry. Then the remaining proportion will now be shared specifically to that company's financial and non-financial performance. That's the methodology we apply at Augusto & Co. and it trickles down. Then our proprietary rating model is now structured along those weights and metrics, which I'll speak about. And then we have our rating committee. Now, rating committee is very interesting because we typically have different members for different types of institutions and different types of buckets. So, I mean, the rating committees that typically look at our sovereign and subnational appraisals are different from the rating committees that look at our corporates, because the skill sets are a little bit different. The rating committees that look at the corporates will be slightly different from those that look at the banking, even though there will be a few interlaps between them, but they are different. The idea is also you want to keep independence, such that one rating committee member does not remember, I have done this for this bank, and therefore it correlates with what I'm doing for this corporate entity because they are lending to this corporate entity. So there's somewhat like a Chinese wall. All of this is all internal safeguards to ensure that you can't really manipulate, and it's a big process. It's a major process across. So that's what informs their methodology that we typically use today. So we use current financial information, minimum of 3 years audited financial statements. In some instances, that has been relaxed to 2 years. Provide your management accounts, you provide your forecast, you now provide information specific to that company from an operational standpoint, from a credit standpoint, from a governance standpoint. So, I mean, I will list out all of those conversations, but the idea is that's the big picture we look at in carrying out our assessment. Moving forward, now let's dive into criteria. So what I want us to do here is I want us to dive into criteria. So as I mentioned at the beginning, we'll be exploring two of those forms, the corporates and the banks. So what I've done is to highlight the criteria we typically look at in appraising a corporate entity. Now, corporate entity in this case, we're looking at the industrial and service companies. Industrial are those who manufacture goods, and the service companies those who provide non-financial services, not bank-related services. Perhaps I'm providing technology solutions to you, I'm providing consulting, those are all services. But the industrial are those who provide hardcore goods, the guys who provide this kind of stick, who provides our TV sets, all of those hardcore items. So we typically group them together into what we call the corporate ratings. But in that corporate ratings, different industries will now have different pillars. Because the way you treat a telecom company will not be exactly the same way you would treat a real estate business. They are fundamentally different. One is a cash cow, telco. One does not have cash. He needs cash to carry out his assignment. So the metrics, the weightings would all change. So you can begin to see that as we keep going deeper, you begin to see metrics and parameters keep evolving, keep changing, and they're not static. They change as the environment changes. So every 2-3 years, there is a review of those parameters because you want to be sure that those parameters reflect current realities. I mean, COVID happened. You can't keep benchmarking people with the same metrics you were using pre-COVID. Even though we say there is nothing like post-COVID, but there is. People are getting back to those levels they were previously pre-2019, 2020. So yes, those methodologies, those metrics exist, and we keep calibrating them. The reality is that business is no longer business as usual. The same way with ESG becoming a key issue, climate change becoming a key issue, we have to now embed climate-related factors into the appraisals. So this is just to put it in context that ratings are not static. Ratings change, parameters change, indicators change, and that is a function of research. We don't just wake up in the morning and decide we need to change the ROE or the return on equity or return on asset. No. We can't just change the benchmarks. It's a function of studies, which is why we have the analysts monitoring these particular industries periodically, giving opinions on what has changed, what is changing, and what are the trends. That's the basis of our. So, I mean, it's just to re-echo my sentiment in the morning. You can't have a rating agency without a research arm. It does not. It doesn't work. It's difficult to work because it's built on research. The history of the 3 rating agencies started with research, statistics, publications before they eventually ended up being rated. It's the modus operandi. So let's dive into the actual conversation on criteria. Now we are getting deeper into some of the technical jargons, and I'll try and pause at intervals for these technical jargons. We start with the corporate entities. I mean, the bankers here may think this does not concern us. It's not the bank, but you're going to be lending to those corporate entities, so it's important to you. As a bank, you're going to be lending to the corporate. You're not going to be. I mean, I know you could do interbank transactions, but you're going to be lending to the real sector, and therefore you need to understand what credit risk do they have. And you being a player in that space as a real sector player, why is it important to you? You need to understand yourself so that as you're approaching the banks, you're approaching them from a standpoint of understanding. And from a standpoint, I know what my risks are. And if I'm able to command certain negotiation power in my pricing. So both sides of the divide need to understand what's happening here. That's what I wanted to point out. Both sides, whether you're on the buy side or on the sell side, you need to understand what's happening in the corporate space. So that's why I was speaking to it first. Then I'll speak about the banking space. Now, under the corporate rating criteria, as part of the soft issues, we look at industry position, industry risk. They look soft, they look like qualitative issues, but they also have quantitative metrics to them. And I'll give you a typical example. If we're to measure your industry position, we'll be looking at what's your market share. How would you measure market share? It's not by believing or thinking that's the market share. It's by doing an analysis, an assessment to say, okay, today the Commercial Bank of Ethiopia accounts for 54-56% of the total market. How did we arrive at that? It's based on research. Meaning we must have looked at the total loan value in the market, how much is in their portfolio, and that is research driven. So industry position, as that, it's a sub-qualitative metrics, but it is founded on quantitative metrics. And that's how most of the qualitative, so-called qualitative metrics have components of quantitative. And by the time we get to management, we talk about character. We'll explain to you how we use quantitative metrics to measure character. Character looks qualitative, but there are some quantitative measures to measure character. But I just thought it's important to begin to shape our minds that a lot of those quantitative have qualitative undertone. Qualitative have quantitative undertone also in it. So the first parameter is to look at the industry risk and industry position. Industry risk, what is the risk in that industry? We talked about it earlier, and that will now metamorphose from whatever we've done as analysis, either using the Peston analysis, the Porter's 5 analysis, the IAT analysis called the Industry Attractiveness Tool to measure the risk. And that risk could be high risk, medium risk, low risk. You can decide to categorize it from a triple A to D also. Some people use high, medium, low to categorize those kind of risk. That will not fit into this particular criteria, and then the industry position. Beyond the industry risk and industry position, we'll take another dive at another criteria called ownership, management, and staff. So let's break them into three parts. Ownership. Who are the owners of this business? Is it closely held? Is it diverse holdings? Is it owned by institutions? Is it owned by individuals? These stakeholders, do they have an interest? Do they have a say in the affairs of the company? Are they represented at the board? These are metrics under this one that we would look at. So what I'm giving you is the headline. In each of those components, thousands of metrics to look at. Thousands of metrics. We can't go through those metrics today because there are a lot of them, which is why we ask you to fill a questionnaire having over 150 questions to give us information that will help feed into those systems. So ownership alone has a lot of questions. The board, the owners, where are they from? What interest do they have? Do we have a majority owner? Do we have a minority owner? Do we have corporations holding stake? Is it government owned? What are the risks for different types of ownership? And we'll give an opinion on that. We go to management. Management competence, management stability, management track record. Competence will be who are the key decision makers in that particular company. The managing director, the CFO, the CRO, do they have the right competence in terms of academic qualification, in terms of experience? So we're not looking at the individuals running that business, because I tell you the truth, management is usually a reflection of how a business does. Management reflects how businesses operate because they bring strategy, they have the push. So you do management appraisals. Beyond competence, you look at management character. What is their character from a management staff? What have they done in the past? What are they likely to do? And let me put it in context also. I mean, when there are changes at management level, senior management level, especially MDs, CFOs, they come with their own policy and their own agenda. Whether you believe it or not, they all have an agenda. Either I want to be very profitable, or I want to minimize costs. That's usually the basic of the agendas we typically say. That either I'm a cost minimizer or I'm a profit maximizer. Without going into more details, you choose where you belong to. You see companies that are focused on cost cutting. Some other companies are focused on what? Develop boosting revenue. They are both strategies. And you tend towards one area. You can't have a fine balance. You tend towards either I want to cut costs so that I save, or I want to do what? Go all out to get more. And remember, I mean, money begets money. If you understand what I'm saying, money begets money. You use money to get more money. You don't use less money to get more money. You use more money to get more money. In tomorrow's session, we'll talk about how money begets money. Because you have, there's a tendency to have more. Because you don't have, there's a tendency not to have more. It's a psychology test that has been done and proven. So, management competence, management character, track record. What have they been doing in the past? Are they a square peg in a square hole, or a square peg in a round hole? These all have metrics that will come under the ownership. They will not have staff. But we think staff is not important. A critical component. Without staff, management cannot operate. You are powerful as a staff. And therefore, we empower you to be powerful because you are part of the rating process. You have a component to play. If you don't have the right skill sets from a recruitment standpoint, the staff can mess up the whole entire business. And therefore, we check the quality of the staff. What is your onboarding? What is your recruitment process? How do you get your talents? What's your attrition rates? Why are there attritions in the organization? Big issues, big questions that goes under staff quality. Beyond that, what about trainings? What's your training plan? Which is where we speak to the HR. What's your training plan for each staff? How do you develop them? I mean, you're beginning to see we are going beyond the remit of credit, but it's a function of credit because it all affects credit. It all affects credit rating. We do staff appraisals. How do you do your staff appraisals? What's your promotion? What's your attrition? What's your weed out? How do you onboard? What's your training plan for each staff every year? All of that needs to be submitted to the rating agency to give us an opinion on how your staff quality. Also, we talk about staff compensation. Are your people well compensated? Do they compare to the markets? Because if they don't, and they are key staff, sooner or later, they will go to your competition. And therefore, your processes, your systems, you think they're not dependent on, they could be institutionalized, which is interesting, which is fantastic. But staff are the ones who drive those institutions. People drive those things. So another metrics we look at staff quality. Now, what one of this puts to our mind is the fact that beyond looking at the nomenclature of we want to look at your ownership management, we're looking at so many other intricate details, which on the back of the survey and the questionnaire would ask you to fill, would get information on. That helps us put into our model. But remember, it is what you give us that will put into the model that the model will bring out. You see where the garbage in, garbage out comes from. If you have given us wrong, or let me put the word. Let me rephrase it. If you have given us incorrect information, and information is not a true reflection, the outcome of our model will give you that same reflection. Because the model will look at what you have put in to generate. So if you've lied or you've not been truthful in information you provided, the rating outcome will not be truthful to you because it does not reflect your true position. That's how these things work. So ratings are dependent on information, and you must be willing and happy to disclose, which is why we ensure you sign a non-disclosure at the beginning, such that you are not worried about the sensitivity of the information you are giving to us. So important. So important. Let's leave some of the qualitative issues because there are more. Let's go to some quantitative issues. Yes.
Could we also reflect on what we are learning? Because I had a chat with my colleagues from EIH. I was saying pretty much the same thing, if I'm not mistaken, because they asked me if EK would be willing to share with the EIH their model so that they could work and sort of an internal rating for their portfolio companies. I think part of my response was, this isn't entirely new. If any of us has been through a due diligence process, this is a typical due diligence process, but with a different twist. The end game here is to assess creditworthiness, to assess ability to pay, to assess risk of default, and in the case of default, a potential loss, to make that assessment. But the same exercise can be instilled in our process. If we were to take a company to a listing through an IPO process, or what we call an IPO readiness process, similar process in terms of the rigor. If you are a portfolio manager managing a portfolio of companies and getting to understand what's in there, similar process. Understanding people, understanding culture, systems and process, governance and controls, understanding the leadership, the management, it goes on and on to the minutiae details. That's what they're doing on the credit ready. I'm trying to kind of make it as interactive again. I know he's on a cruise mode, but if you still have questions, please press on me and I'll stop him.
Okay, thanks, Fazi. I mean,
oh, there's one there.
Okay, good. Yes.
Excuse me, can you turn on your mic?
Oh, sorry. You haven't mentioned the board, which in the model would, I think, be the governance. I think it's extremely important in companies that are not owner managed. The independence on the board, they do the strategy. What do you think of where does the board fall?
Okay,
that's a good one. Any other additional thought or questions?
Okay, I think I see one.
Just a quick one. In terms of when you say like all this report will go through the credit committee, and so is the committee composed of independent industry experts, or are they hired by the firm? How does that relate to the conflict of interest? Because if you hire me to assess a bank because I'm a financial sector, how does that conflict of interest works? Thanks.
That's a very good question. There's also one more question from our online attendees. Will you be publishing your macro industry analysis and predictions ahead of time so it can be used for further evaluation of your ratings?
Okay, I like that question. Okay, so fantastic questions. I mean, so let me start from the first one, then I come to the last one. In terms of board and governance, it's captured under the ownership assessment, and I think I just touched a little on it, not to dwell on it. There is a complete board evaluation, and I think earlier in the morning I'd mentioned that there's some criteria we look at, say, how many people are on the board? 7. What's the diversity? Do you have non-independent or independent non-executive and executive composition? So also, do you have board committees that oversight for audit, for remuneration, for governance? Yes, so all of that is factored into the supposed soft issues under ownership, because again, ownership stakeholders are represented through the board. You get where I'm coming from? The stakeholders are represented through the board, which is why sometimes we have what we call shareholder representatives for minority shareholders and for majority shareholders. So all of that goes into the assessment under ownership. So I just touched on it a little, but the key point is that under each of these components, there are a lot of metrics. A lot of metrics. But what I'm trying to do is, I'm supposed to put up the metrics that are critical, that we need to know, that we need to be aware of. Then when we're now going to specific industries, we can now begin to drill down what exactly do we look out for. Because, I mean, for a bank, we'd expect you to have a larger number of board members, a larger number of independent board members compared to a corporate entity. Also, depending on your size, how strategic you are in that particular country. You know, there's some companies that are called systemic strategic, meaning if there's a challenge with such companies, it can cripple a particular system, an industry, or even the country. Systemic, they're very systemic. In some countries, they demote them as SIMs and then give them special preferential treatment, because one run on one institution, I mean, I'll give you an example. The Commercial Bank of Ethiopia. Whether you believe it or not, it has a systemic risk on Ethiopia on its own. You go to the telecom space, you have such entities around several industries. So therefore, some way of trying to not build favoritism, but trying to protect, because if it goes down, it carries a lot more than a smaller fringe player. So I'm just saying, all of those, therefore, those kind of companies have stronger boards, stronger representation, you know, much more due diligence done on them than the others. But it's the same playing field that they're all playing. The second question on committees, independence. Yes. So they're going to be industry experts who have an understanding of credit rating and also of that particular locality or industry where they are providing information on. So usually it's not just random people you put on committee. They must be well versed, they must understand credit. They must have also, sometimes you take them through training. In fact, there's annual, semi-annual training you take these committee members, because they also need to be updated on what's happening in the market, in the environment. So yes, so independent members. The preference is usually not to have them, not to pick people who are still sit on boards, so that they are not compromised. Is to have independent people who are perhaps independent consultants, sometimes lecturers in universities who are doing the theoretical part of it, and look at, so that's how then you put a market overlay for them, give them the market context. So that's how we.
How would you compensate them? Because compensation becomes, tricky in this kind of environment, right?
Yeah,
That's a really good
management
question.
of rating agency. How we manage rating. So there is compensation. Yes, they spend their hours reviewing credit. Yeah, no, so yes, it's like board directors, when they sit, don't they get paid? They get paid. Board of directors, they get paid for every sitting. So same.
But how would you make sure that there's no conflict of interest?
So
because I come from an industry, I come
from that particular industry. How would you make sure that when you compensate me, when you pay me to review all those documents, give my assessment, vote on all that, how would you make sure not to compromise? Because one of the banks, because as an industry expert, it's so easy for me to, to connect with my peers, with my board colleagues, talk about this, and how would you make sure that?
Okay, so 2 ways. First of all, thankfully you're not the only one making the decision. There are more people in there, there are more committee members. So if we have one that's been conflicted, I mean, it could happen. So let's not take it out. It could happen, but because you're not the only one making the decision, you have to find a way to conflict every other person. And sometimes you really don't know who are the other members, except when there are split decisions. We now have to relate. So then another way we do this at rating agents and Augusto and Co is they do what they call asset declaration. at the beginning of the year, even we staff members declare our portfolios, our assets, such that if you're invested in one particular space, you'll be excluded from such assignments. So we have those, like politicians, that you just want to start a career, they ask you to declare your assets. You need to know, so that when you're finished, you know how much assets you have. I mean, such kind of, so I'm just saying, those are ways, safeguards. There are a lot of safeguards, and some of them are best practices, international practices, which is why the rating agency kind of assessment and kind of work is quite different from, because I mean, while I was in the banking industry, I never declared my assets. What's coming? You have to declare your assets, and they have to know what you own, what you have, and if your lifestyle changes significantly, you know something has influenced it. So there's just checks and balances. But
also, it's an industry that relies on reputation and integrity and independence, and I think not declaring who are your core committee reviewers in avoiding collusion, and also like there's got to be not just one layer of reviews, but I believe there's going to be a second, third layer of reviews to see any outlying recommendations than what is supposed to be, and I think that can be examined and checked.
Yes, so thank you, Fasi. So maybe one of the things I didn't talk about is the fact that so there's the analyst or the team of analysts, then there's the manager who does the review, then internally you have your directors who do their reviews, then the group managing director goes on before it gets to the committee. So it has gone through internal reviews. I mean, if there were already issues that have been spotted, clear. When it gets to the committee sometimes says, okay, I'm not satisfied. I want to have direct contacts with this client, have an understanding. In some instances, okay, the analyst and the manager come and explain all of these whole new things you've put in, all of these new assessments. So those checks, those layers, I mean, they exist, and sometimes it can be time consuming. It can be time consuming. So let's move on so that we can make progress. We've done the first two, industry and ownership. Now let's talk about some of the quantitative. For a corporate entity, we'll look at profitability. Profitability here would be from a standpoint of want to look at your growth, your sales growth, or your adjusted sales growth, called the real sales growth, where you've adjusted for inflation to be sure you're actually growing. They're not growing. We'll look at your margins, your gross margin, your operating profit margin, your EBITDA margin, your profit before tax margin, your profit. We look at margins. We look at your returns, return on your assets, return on equity. Now, those are specific metrics that will be assessed, but they are all financial in nature. But again, sometimes those financial, because we don't look at 1 year, we look at a trend, minimum of 3 years. It means there could be changes, and therefore we would need you, the owner of that business, perhaps the CFO, to provide context to why has there been this kind of changes. Or if you say positive trajectory, what is driving the positive trajectory? We see a negative, what is driving, or we see one up today, down tomorrow. So that interaction with the management provides clarity on that profit. And the same conversation goes for all other metrics. Working capital, we look at how much working capital is required to run this business from an operational standpoint. And one of the bubbles I want to burst here is that the way credit people look at working capital different from the way banks look at working capital. So working capital, typically, if I ask you today, what is working capital? You tell me working assets, which is your current assets minus your current liabilities, or your current asset divided by your current liabilities. Meaning, this is what I have as assets. Can I use it to repay my obligations? But from a credit standpoint, we look at it the reverse. Do you have enough spontaneous financing credit to meet your liquid requirements to operate? We switch it. We don't check how much assets you have to cover your liabilities. We check how much of good liabilities you have that can help you continue to operate without. It's a credit, it's a switch of accounting. We don't look. So I'm just saying the technicalities are different. So I'm not going to go into the details, but the idea is that we are focused on risk, and we are saying we don't expect you to sell your assets to meet your obligations, because we want you to continue as a going concern. But rather, do you have sources where you can get good credit to continue to run as a going concern? Because you are preparing your accounts in a going concern version, but the accountant looks at assets, vis-a-vis liability. We look at liability vis-a-vis assets. Let's not dive into the more technical, but just to put it that some of the metrics we look at here would be the converse or the reverse of what you typically look at as an accountant. And the rationale is clear. Why do we do this? If you have supplier credits, would ask you to use more supplier credits than dispose of your assets. Supplier credits means you give me credits and say don't pay until 90 days. That's free money I can use to continue to do my business. But why would I be thinking about how much assets I have that I need to liquidate to meet my obligations? So what would I push for? I'll push for supplier credit, which is what we call spontaneous financing. It's called spontaneous financing in the credit world. It's called how much spontaneous financing do you have? So that's how we measure our working capital. We don't measure it from an accounting perspective. So meaning the numbers we get, we have to reconfigure the numbers to suit that analysis. Are we still together? Because I can see your faces are we still together? I'm just saying, I'm just giving highlights of the kind of differences and technicalities. But I'm not going to dwell on those technicalities because there are a lot. There are a lot of them. Let's leave working capital. We go into cash flow because that's also another metrics we try to measure corporate entities. When you talk about cash flow, the big question is from an accounting perspective, an accountant will tell you cash and cash equivalents is cash flow. But that's not cash flow. Cash flow has three segments, three components. There's the operating cash flow, there's the investing cash flow, and there's the financing cash flow. From a credit risk standpoint, the most important cash flow metrics is operating cash flow, which is focused on your operations. Financing, investing are third party. Financing means you're getting from someone else. So can you run without getting from somebody else? That's the first question we ask you. Can you run your business without getting from someone else? If you can't, then there's a weakness. Can your inflows cover your outflows on a day-to-day basis? Is operating we'll look at before you go and ask for financing. Investing would mean either you're disposing of some assets to get value. So our analysis will focus on your operating cash flow, which would not be the same as your cash and cash equivalent because your cash and cash equivalent would have been bloated by your financing or your investing activities. You begin to see how the rating agencies begin to look at things differently. That by the time we come up with our reports, you'll be wondering, but I have much cash. I will say, no, you don't actually have cash. You have cash because you borrowed, you have cash because you sold an asset, and do you intend to keep selling assets every year? Is that sustainable? Those are big credit questions. Remember, we're focusing on risk. And the first risk we want to look at is your operating risk. Can you run on net basis? What comes in from your sale of your product and services vis-a-vis the cost, which is like for the banks, your net interest income and your interest expense. How much are you? How much is your spread? How much is your spread? Before you talk about other income. Are we still together? So that's the convention around risk creating. It's becoming a little bit different from the convention because the things we focus on, the things we look at are geared towards risk. Let's keep moving so that we get to where we're going. Then finally, we look at leverage, which has to do with debt. Leverage just talks about debt. It's not a function of debt. Debt in itself is not bad. The problem with debt is efficiency in the use of debt. What type of debt and how is it being used? And what is it being used for? So we look at efficiency of your debt. And it's not because you've taken 1 billion that makes you worse off. It's not the size. It's in the efficiency of it. What it has been used for, what will it be used for, and how it will be repaid back. So in debt computation, a lot of capital conversion comes into play. And you wonder, debt capital, what equity? You want to be sure that you have some shocks from an equity standpoint. Such that if that debt goes bad, can you absorb some of? So we begin to look at things like equity cushion. How much equity do you have in the business to support when there are challenges with your debt? How much quasi equity do you have in your business? Mezzanine kind of equity. Bigger issues beyond what we see on the balance sheet. For the banks, we look at how much of your tier 1 capital, your tier 2 capital. You begin to see different metrics. Your shareholders' funds, your accumulated shareholders' funds for a corporate entity. How much have been accumulated over the years vis-a-vis your retained earning that goes into it. So you see that on one hand, the rating analyst needs to have an understanding of accounting. Then that changes that understanding into credit because it's a different dimension. Let me take a pause. let's digest this, because the next things I'll be showing you here will now become how we calibrate all of this into the benchmarks, because I'll show you some of the percentages we use. Does it make sense? Does it not make sense? Then we'll end the corporate and we'll go into the banking. So let me take a pause and take some of your reactions.
So let me take a quick survey of the room. How many of you come with an accounting or finance background? Can you raise your hands? Oh, quite a number. And how many of you are enjoying this session? All of you. It's getting technical. I'm glad that you're not dozing off. I'm sure you're also like, I took off my jacket and getting ready for this crash course. Any questions? Because it's been looked at differently. How we used to looking at it, it's been looked at differently. How we used to like computing numbers, like in the earlier case, I was speaking about like my colleagues from EIH, like operating lease versus financing leases. He's gonna talk like AK is enjoying it. He's like, please don't bite my mate. I'm not gonna touch that. But like how it's been looked at is different, and the way you look at it is different. It's all like looking at the same thing but from different angles. That's the only way you can get a better view of what you're looking at. So let me stop here and ask for any questions.
Okay, thank you. Maybe my questions probably more technical. It's related to the rating process. So in the rating process, we need audited financial statements, probably 3 years. But in real terms, given Ethiopian corporate companies don't have audited financial reports, and we may use the provisional one. So related to with this, how can we validate the data, and how can we compromise the variance between the provisional data and the audited data, given we didn't digitalize our systems, and we are in the process of implementing the ERP system. So how can we compromise the data validations and the value?
That's a good question. I'll take it up to answer it for you because he may not have the local context, but I'll take that one for you.
Under other considerations, I read significant change in ownership as an area of concern, or an area that you are going to look at it. I mean, what would be your focus on those spaces, and why?
Okay, thank you. So, from the system thinking point of view, maybe support of getting that question. A company could have a lot of data. So you have said we'll analyze the company's data. How do you validate the company's data? Again, it's not actually from authentication purpose. Sorry, authentication purpose. The company cooks the data actually. So is it the verification process part of the rating process? And the other question, maybe I would like to hear your best experience how to establish a data from the companies, because it's not easy here to, the very first step is establishing this set of data. So what are the best practices you have been using to share with us? Maybe one more question. Do the steering committee override the rating score? Or are they separate?
I like that question on our side.
If no other questions, I may start by responding some of the local context questions. Look, if no information means no rating. It's as simple as that. I think I had my colleague Sagamlak, who was here, a lawyer. He's done some due diligence work for clients, and they've been reluctant to provide that information. And then at the end of the exercise, he had to go back with responding, no information, no information, no information. And of course, they were not able to pass the DD. And then they came back and said, oh yeah, you're the one who put us into trouble. Of course, if there is no information, there is no rating. If there is no audited financial reports, there's got to be audited financial reports. Engage your auditors to do audit of the past 3-4 years. 3 years. It can be backdated. They can do it this year for the past 3 years. If you're not able to put up with putting your house in order, getting all the information that is needed in a structured way, there isn't much a rating agency can do for you. If a rating agency cannot do anything for you, if you're not rated, you have a counterparty risk. Nobody's going to put up money for you in the debt market, and you'll have a difficulty even to raise equity funding to your business, or to even have suppliers that are extending credit for you. So I think we have to move past beyond this excuse of like there's no data, there's no audited financial reports. We have to put an effort, a concerted effort, not a hands-off, but a hands-on approach to compile all the information that is possibly needed for any process, be it credit rating, an IPO readiness, or even your portfolio management or your management of the organization you're in. And that is so paramount. I'll pass it on to EK.
Much for you've answered the question. But again, just to add some voice to it, rating, if you remember our conversation at the beginning, it thrives on information and credible information. So there are instances where you may not have audited your current financial performance. Perhaps there's some lag, but there's some history that have been audited. Then we can use provisional numbers. Maybe you ask you to go get an oath signed, management to sign on an oath, take it to the courts. Those are allowed, but not that you don't have at all, and you want to no. I mean, from the onset of the engagement, it's already been detailed in the engagement letter that you'll be required to provide us audited financial statements for this period, and you have signed. So if you have signed that engagement, it means you have. If you do not have, then you have to have a conversation with us. Then we agree what proportion do you have, what proportion are not yet audited. So, I mean, we've tried to. We know this. We know Africa. We know that it's not. We don't have all those information readily available, but we have some minimum thresholds we can't get below. So I'm just saying, yes, it's possible. No, because we want you to do the right things also. You get one problem. Yes, it's possible, but no, because we want you to do the right things. But more importantly, for a first-time rating client, now this is just so you take it to the bank. For a first-time rating client, those concessions will not be given. Let me rephrase. If you're a first-time doing a rating, those concessions will not be given because we want to see the totality of who you are first. If it's in the subsequent ratings, you have delays because we already understand your business, then we can give some of those concessions. I don't know that makes sense. Because it's risk. We're thinking about risk. We're saying, if you're coming to us for the first time and you don't have any of this information, you're just saying we should come and do it, if the risk is higher. Because we don't even know who you are. But if we already signed a 3-year, 5-year contract and in year 3 you're having some issues, we already have some data, some history on you which you've provided. We can say, okay, give us provisional numbers, give us management numbers, take a note, but not for the first time. You want to, because we also need to get approvals for us to use such financial statements that are not audited. But so to put it in context here, we require you to have audited accounts. If they're not ready, we can commence some preliminary work until they are ready. Remember, credit rating is not an audit, so we don't do audits. We're not auditors. We understand the audit, but we're not auditors. We also do not do forensic investigation. I mean, I remember I had someone ask questions around how do we validate the company data? The engagement you have signed, in one of the fine languages we clearly says, all of the information I'm providing to you is true, factual, and there are no errors. If there are any errors, I absolve Augusto and Co. of the liability. And we've seen that happen in practice. I mean, I will share one of those cases in practice. It's public. Consolidated Discount House in Nigeria. It's a merchant bank. They signed all of those contracts and then provided contrary information. They were keeping 2 accounts. One for the regulator, one for the rating agency. You know those kind of companies, they exist. They exist. So we use the numbers they provided to us because they have signed and given true faith that they're giving us credible information. We just did an assessment and it was looking too good to be true. And we kept asking questions. This looks too good to be true. Some things are, when it's too good to be true, it's actually what? Too good to be true. Further conversations, we realized the regulator stepped in and realized the numbers they provided to us, the numbers they provided to were stark different. And they've been giving us falsified numbers for a period of time because they wanted to keep getting their licenses were withdrawn. completely withdrawn, they've stopped doing business. Is it the fault of the rating agency? Because people blamed us. But is it our fault? No.
But also the assumption that rating agencies do not verify should not be taken literally. These are chartered accountants, Some of them are like former auditors. Augusto and Company has been as an auditor, right? Like when he set it up. So it's there are like professionals can make quick judgment of what's being cooked and what has been provided in good faith and with the reality and then the facts on the ground. So I think with that, I have a couple of questions.
I haven't answered 2 questions that were here.
Oh, okay. So I'll hold on because there's a question from our online audience, but I'll hold on.
Let me just answer. Someone spoke about significant changes in ownership. That's what happens. If you look at the fine print below, where we have the other considerations, we have significant changes in ownership. It's a major issue. If your ownership structure has changed, who are the new owners? What's their philosophy? What's their vision? What's their goal? It can impact on the rating positively or negatively. So yes, it's one of the factors we actually look at. Also, we look at litigation. We take a list of all your potential litigations you have and get lawyers to give an opinion on the liability of those litigations, because we need to factor it into our assessment of potential risk that you are exposed to. So we're not just focused on the credit, we also focus on the legal part of it. If you have ongoing suits, what's the likelihood of those suits going against you? What is the monetary value? Because they are called contingent liabilities. Can we provide for them? Can we put them in our assessment? So all of those goes into the assessment that we do. And I think the final question someone asked was around data and verification of data. We will do our best, which is why we have foots on ground in those locations to do our research, get local context and knowledge. But if you have falsified the data to the extent that we cannot clearly pick out the falsified data, we'll use it. Whatever outcomes it provides will be that. But remember, you've signed a contract which makes you legally binding on whatever information you provide. So that's why that is the first step of the process, to sign that contract that binds you into this transaction, so that you can wake up tomorrow and say no. And we do not just allow anyone to sign that contract. That will be people who have authority, because we've seen that in practice too. They let junior people sign such that they can disclaim that they do not provide. We also have our own internal controls to ensure that such contracts have been validated, because there are specimen signatures for every company. I'm sure you know. So I'm just saying, rating agency work is quite an interesting exercise, but which is why it takes that long. It's not something you expect in 1 day, 2 days. No. That's not written. You can ask for a credit score in 1 day. The credit bureau has already kept data of your relationship with other banks, how you've been paying or not, and they go to the system and click and generate a report that shows a score that shows you have been paying or not been paying. But they're not assessing your current, they're assessing what has happened, what those banks have registered for you on your name or on your company previously. So a credit score is different from a credit rating. We use credit score as part of the things we put in, but it is one of those very minute details we put in. But beyond that, all of this is what we now focus on. So let me allow you to take your question now.
I think you also explained earlier on that a client pays a credit rating agency ahead of time, right? I just wonder how you would pay off and just let the credit rating agency off the hook by falsifying information or managing earnings or not providing the true and correct information, hoping that they're not going to find it. It's crazy. That's just additional comment. Particularly if you pay for, a self-reflection, you'd want to have a true reflection of yourself. And I think I'll leave it at that. There's a question here. Will you be publishing your macro industry analysis and predictions ahead of time, so it can be used for further evaluation of your ratings? And that's a question in relation to, let's say, if you're working here in the market in Ethiopia, will that be available for everyone so they'll be able to see how consistent you are in your ratings and in what you incorporate into any of the industries and the companies you're this particular person who questioned, he even complained saying you busted my question. You're not busting his question. And the second one is the one limitation of using financial statement problem is a problem of earnings management, which I just highlighted. there's really no point in providing false information for a service that you're paying for. You'd rather have it rated and then say, oh, I don't like the rating, so please don't publicize it, and I'll use it internally. Maybe that could be a possibility than having to pay for a falsified and a wrong impression of you. It sounds more like photoshopping yourself for social media presentation. Does it sound like a good example?
Yeah, sometimes people do that because they want to have a different impression from the counterparty. So they use that so much. I mean, the good thing and the wise thing to do is to provide credible information so that it reflects you credibly, and therefore you can stand tall to defend those results. So speaking on those macro data, at the moment we publish for the countries we operate. If you go to our website today, www.agusto.co.ke for our Kenya website, we have for Kenya, we have for the industries. However, we have what we call brief summaries of those reports, because those reports are very detailed reports. So we have brief summaries that gives you high-level insight on those. Now, what we've also done is that because of abuse, we've created a subscription system where, because getting research is also expensive, a subscription whereby companies, corporates who want to understand those particular better details, apart from the 3-page or 4 pages online, will now subscribe to those. But however, it's available online. So if you go online today, you'll see you will carry it up to 3-4 pages. But when you now want to now dive deeper into it to begin to use them for your purposes of your own judgment and decision making, then would ask you to do what? Subscribe. So we have a subscription system that you subscribe, and then beyond the subscription, if you want to get access to the analyst who has written those reports to ask further questions, more details, want to probe more, those subscription services now exist. So yes, they're available, but the versions available are not the full encyclopedia of the research that we do and release on a periodic basis. I just thought to provide context.
So basically, you're saying don't feel ghosted for reading only 3 pages of a summary, instead of having to pay for a full subscription of the entire details.
Research is expensive too. I mean, people have to be on the streets. People have to be going about doing the survey. So who pays? Someone has to pay. Which is why we're giving you some idea of this is what the industry looks like. This is what this government looks like. But you want more, and that means you're an interested party. You're willing to pay for it. But what goes out to the public, because also put it in the papers, is just the brief. How many words can go into the newspaper or go into adverts or go into publication? 3,000, 2,000 words. But the main details, specific analysis, the charts, all of those information, you now have to do some subscription to it. That's how we end up getting good analysts, and they keep being on our payroll for long. So let's move into the next conversation around the scoring and the parameters. What we tried to do here was to look at the major headlines, and I tried to book that there are specific parameters. But now I want to now take you into wearing the cap of a rating analyst. How would a rating analyst go through this process? The rating analyst starts first by looking at factor 1. Factor 1 is called the main factors, the industry, which is I told you some of the parameters. Factor 2 is the financial condition. Factor 3 is management, ownership, and governance. Now, on the back of these 3 major factors, we have what we call the sub-factors. Yes, I'm coming to you. Just a second, let me run through this. We call what we call the sub-factors. Sub-factors are now subsets of those main factors. You have your industry performance, you have your industry averages, your profitability, your cash flow, your working capital, liquidity, leverage, a whole lot of plus your outlook. Then that gives you a credit profile of that entity. Beyond the credit profile, you now have what we call the nurturing criteria. To say, okay, do you have parental relationship and support? Example would be if you have significant support from a state-owned enterprise, from the national government, that influences and impacts on how your credit is perceived, positively or negatively. And therefore, we look at what kind of support exists for your operating as an entity. And I'll give an example. The Commercial Bank of Ethiopia, I think, if I remember the exact percentage, Christine, if you can remember, of how much ownership the national government owns in Commercial Bank of Ethiopia. And therefore, if we were to appraise Commercial Bank of Ethiopia, we'd also have to look at what stake the government has in it. Positive stake? You may want to say yes, because it means if the bank runs into any trouble, the government will do what? Step in. So therefore, that will impact on the issuer rating of the Commercial Bank of Ethiopia. So think about it for Ethio Telecoms. Think about it across. But also, if the sovereign has a weak risk, has a weak perception, it can also drag down the credit quality. So don't say yes, it's Uhuru is positive. It could also act in the contrary. But the idea is that those kind of support, if it's a company, a corporate entity, perhaps has an affiliation with an international brand, international company. I'll give you an example. You run Coca-Cola here in Ethiopia, and there's Coca-Cola International. You bear the same name, they provide support to this business here. It's positive influence. Meaning, if Coca-Cola Ethiopia, for example, was supposed to have challenges, Coca-Cola International would not sit and fold hands. They would provide some support, technical, financial support. And therefore, that should count for your rating as an issuer. And it's on the back of that, we'll now arrive at what we call the issuer rating. So this process would apply for any type of rating. What changes are the factors and the parameters that we now assess. Yes, I know you had a burning question to ask. Let's take your question if I talk about the specific weights and benchmarks. Yes.
Thank you. My question is on your previous slide.
Okay. Yes.
So if I captured correctly, when you discuss about working capital, you mentioned that the current asset and the current liability side, the most important one for credit rating is the credit facility side. But that is from the investment, from the financing side in terms of cash flow statement. But when we talk about adequacy of cash flow, you told us the most important thing is the operation side again. Does it conflict?
Conflict. Yes, I knew that question was going to come up. And we're ready for it. Thank you. So it doesn't conflict. Now, when we talk about working capital, we're saying if you're to measure your working capital position today, what you would do would be, as an accountant, current assets divided by current liability to get your current ratio, which is they'll tell you 2 times your current ratio, meaning I need to have more assets to cover my liabilities. But we are saying that is an accountant way of looking at it. Think about it from a credit. The credit analyst will ask you how much of spontaneous financing, how much of creditors' liability do you have that you don't have to pay today are available to support your business. So it is not necessarily operating cash flow. We're saying how much credit lines do you have? How much credit has been granted to you that you have to pay today? As for those credits may come at zero cost. When they come at zero cost, it's what they call non-interest bearing liabilities. So I'll give you an example. I am a supplier of this particular TV set, and the manufacturer in Japan sends it to me and gives me 180 days before I make payments. The product has arrived. It means that I can actually take this product and go and sell in the market, get value, and return back to him within 180 days. Have I used my money to do business? No. I've used what they call supplier credit. And therefore, as a credit risk analyst, we do not expect you to go and look for financing elsewhere. We expect you to have a lot of credit from your suppliers that enable you to run your business. We do not follow the perspective or the perception that says, go and liquidate your assets so that you can quickly go and pay for that obligation. Rather, use other people's money and run your business if it is possible. In some businesses, it is possible. In some industries, it is not. But the idea is that from a working capital standpoint, you are more positive to get a positive rating when you're able to use supplier credits compared to using your own finance. I don't know if that makes sense from a credit rating standpoint, because it is a leverage, meaning I can do my business without putting 1 penny into it. I use goodwill because I have good supplier credit, and that counts for your qualitative issues. Because for you to be able to get that kind of supplier credit, your character, your governance must be in place. Are we saying? Now, juxtapose this to cash flow. Cash flow metrics, typically people look at cash and cash equivalent. What do I have in my bank account and in deposits? And we are saying why that is good. But on an operating basis, on a day-to-day running, on a monthly, annual basis, do I have enough inflows from what I sell vis-a-vis what I pay? Without thinking of getting financing from the public. Remember, this is a different metrics from working capital. This is now testing cash. Cash is king. How much cash do I have? But we say do not test on cash and cash equivalent, but test on your operating level, because it's the operation that will sustain that business. So they look like they're conflicting, but they're not. They're serving 2 different purposes in the analysis. Because from your working capital, I can determine and tell you Because your working capital credits you're getting is not enough, you need this amount of financing to meet your asset requirements. Rather than sell your assets, your liquid assets, convert them, go get more bank financing to cover that shortfall for that number of days or that period. You see the difference. But as we dive into it,
I'm sure he understands it better. Ethiopian Airlines collects cash before we even fly.
yes, so they have big on spontaneous financing. Okay, so let's move forward. In terms of the slide and stop moving. Okay, in terms of the factors, I was just trying to explain here that this is now the what goes into the analyst's mind in terms of preparing the schedule. Factor one, sub factors, parental support, and get the issuer rating. Now let's dive into some parameters as we move on. Please, can you just touch the screen? Our slides are not moving anymore. Okay. Now we want to now begin to decipher each of those specific, not all of the parameters. I need to plead. I'm going to touch on a few of them and allow us to think about in our minds the others. Let's talk about industry position from the qualitative. How do we measure industry position? And I gave some, and I think I alluded to this earlier, that we look at your market share. How do you measure market share? Is qualitative or want to measure it in the quantitative? We say, what's the company's turnover vis-a-vis the industry turnover? For you to get industry turnover, you must have done industry analysis to aggregate data. So research comes in. Your industry assessment analysis must have been done first. And we are saying corporate entities that have turnover above 20% of the industry, they are a significant player. And therefore, on our rating scoring, on our rating band, we'll give them a 1 score. A 1 score means a good score. And therefore, if we now say we're supposed to put industry position on our grid of 100% as 20 marks, what would this represent? 1 will mean you scored the full marks, meaning you scored the 20%. If we go below the company's turnover vis-a-vis the industry between 15 and 20%, the company will score a 2. What will 2 be out of a 20% proportion? It will depend on where they are between 15 and 20%. Therefore, we do some computation to calibrate it. Those who are at 19 will score a little bit higher. Those who are 15 will score a little bit lower, but they are still on a good pedestal. And that's how we calibrate. So what has happened internally is that you've put buckets, parameters, with clear indicators that the metrics you measure will fit into any of these, and therefore it will now come up with a percentage score that shows you where they are in trying to add up to 100%. Because in the end, rating scores is from 0 to 100. You want to add up to 100, so I can give a percentage. AAA, all of those, they all have percentages attached to them, which I will speak to. So that's how the thinking, the methodology goes into it. You put quantitative to measure qualitative issues. So you talk about character. We'll tell you KYC, we'll tell you how many years of experience, track record. If you spend more than 5 years on this particular role, you score 1. You spend 3 to 5 years, you score 2. We are beginning to put scientific ways to measure those things that are qualitative. Are we still together? We want to talk about ownership, board governance. How many board members do you have? If you have between 10 and 15 board members, you score 1. If you have between 5 to 7, you score 2. But in between that 10 to 12, we have another metric to say how many of them are independent, how many of them are non-independent, how many are executive, how many are non. You understand where I'm coming from? So it becomes layered on each of them. And therefore, you now have a matrix that will show you, I have seen boards of 10 to 12, which they scored 1. But in terms of non-executive and executive, we have a larger proportion of executive than non-executive, and therefore it reduces the score. We go beyond and say, these non-executive and executives, what roles do they play from a board committee standpoint? Do they chair the committees? Who chairs the committee? Is it the independent or the executives that chair the committees? It calibrates further. Same way, continues with different metrics. That's how. So, which is what I'm saying, there are so many indicators, but these indicators are fed by the information that's been provided by the client that we have validated through those meetings and those engagements. So it will not be wise that even during those engagements we have, you do not tell us the truth. Because all the information we're trying to get is all the things you put in those data. We need to validate them through those sessions and those visits. So if you find a way to be very clever to hide all of these things in all of those processes, we assume that the information you're giving to us is true and we use it that way. And will not be held liable for the outcome. Are we still together? Now, this is just on industry position. So I'll try and take, on each of those factors, take 1 or 2 scoring metrics. There are many of them. And the ones that we can relate to so that we can actually see how this thing drives into the scoring. Then we'll show you how the scoring grid will look like. And we'll move into banking. So you see, we're still on the corporate. We've not done banking. And we're supposed to also review case studies using these metrics. The goal is we want to look at now, if you were to be a rating agency, because people have expressed interest in rating agencies. If you were to be a rating agency, how would you appraise based on these high-level indicators we've provided to you? So let's move to the next slide, which now speaks around profitability metrics. Profitability metrics here, we want to talk about two key metrics. We want to talk about sales growth. Oh, okay, our slides have not moved. We want to talk about sales growth. I also want to talk about return on equity. Sales growth is a growth parameter and it's not a year-on-year growth. We look at a trend over a 3 to 5 year period. Now, at Augusto Uncle, what we've also done is for this kind of corporate, remember, depending on the industry, the benchmarks could be different too. So we've put a benchmark to say if you score above 12% in terms of your yearly growth, you are strong, meaning you are growing higher than perhaps inflation, depending on the inflation in that country also. This is also not adjusted for inflation. This is just nominal growth. And if you score less than 0%, meaning you are not growing. So typically, picture it in your mind, the strongest who scores above 12% will score a AAA, which is the highest rating. And those who score the weakest will score what? A D, which is in default. And therefore, every other rating category will be between 12 and 0, meaning double A, single A, triple B, all of it will be between 12 and 0. That's how it's calibrated. So therefore, when we appraise a company on sales growth is change of total sales from 1 year to another year. 2023 sales vis-a-vis 2022 sales divided by 2022 sales. Current minus previous divided by previous times 100/1 will give us the position. I know I'm speaking to non-accountants and accountants, so I'm careful about giving too many technical jargon. But we're saying, how much have you grown year on year? 1 year vis-a-vis another year. To compare 2 years, you need to put the current year forward minus the previous year divided by the previous year times 100 to give us the percentage growth. It's like your budget and actual. It's the same metric. So we've put parameters that are fluid at changes for sales growth. This is an indicator. What does this indicator do? This indicator measures if this company is growing or not growing. And it's important in credit because we are giving you finance today to pay tomorrow. So we need to know what your trajectory of growth is. Ethiopia has been growing at an average of 5% in terms of GDP over the last 3 to 4 years, 5.3, 5.6. So that means Ethiopia's sales growth, if we're to call it that, but which is called GDP growth, is 5%. Have you seen where this, that's how this whole competition comes to play. It is scientific, but it has to make sense. And therefore, we can now compare you to the industry to say, what was the industry's growth rate within these 2 years? Was the industry growing at 12% and you are growing at 7%? That means you're not growing at the industry level. What are you doing that the industry is doing differently? Or who are the players in the industry that is driving this growth? Because in industries, you have both the high and the lows. And it is that gives you the average. So if the average of an industry is like 12 and you're doing at 5%, big questions to be put in your report will be, you're not growing at the pace at which the industry is growing. That means you are having challenges with your sales, with your market penetration strategy. So in a nutshell, rating can become like an advisory document that tells you where your issues are, where your problems are, what can you do to improve. Are we still together? Let me finish the profitability and I'll come to you, sir. Beyond sales growth, other profitability measures we wanted to look at here is what we call return on equity. Return on my investment. I've made investment. So how much return am I getting? I mean, we've put a benchmark to say, if you score above 30% in a real scenario, you are doing well in terms of the return. After you take out profit, after you take out your taxes or non-default taxes, are you doing well or not? If you are doing less than 15%, in most economies in Africa, you're not doing well because the inflation rates are high, and therefore you need to earn above inflation rate to be said you are doing, otherwise you get what they call negative return. If inflation is at 28% as it is today in Ethiopia, and you are earning 22%, be ye not deceived, you are making a negative return on that investment. Because your purchasing power seems to have increased, but it has reduced because what you need to buy in the market has gone higher than what you're earning. So usually, that is usually like the flat benchmark for ROE. How much am I earning vis-a-vis the inflation in that part? Inflation rates, inflation indicators, it could also be benchmarked to the government security rates. Some entities will use government security rates. Am I earning beyond the government security rate? If yes, then I'm making good return on this particular investment. But we like to use inflation. So I thought to pause here. Let's reflect on these thoughts. These are just two of the many indicators under profitability. One on growth and one on return. Then I can take your questions. I can see one hand up there, and I have seen your own hands. Please, let's have your question.
So, okay. Um, uh, so in this metrics, so now let's put it on the ground in Ethiopian financial context. Our banks in this context, they're well positioned. Okay, sales growth, amazing. Return on equity, amazing. But when it comes to balance sheet, quality of balance sheet, is it underwater or above water? That's a whole another conversation. So, I mean, as a country that has not implemented Basel II, or yeah, I know, how would you assess that? Because for us, for me personally, it just distorts the whole economy. Because, like, you have a banking sector, the balance sheet is underwater. If you properly give out risk on their each and every credit portfolio, debt contract, I would say most of it wouldn't stand out. So in that kind of context, if interest rate changes, and usually at one point, given Ethiopia's microeconomic conditions, benchmark interest rate introduction, all this is going to affect their balance sheet. How would you assess that? Because this, for me, it's just it's not satisfying.
Okay, fantastic, good question. So I want you to just hold this question a little longer. Let's get to the banking. You know, we're doing corporate right now. So these metrics you are seeing here are corporate related metrics. So we have this same schedule, but now the equivalent for the banks. Remember, we said we had two case studies, Ipswich and Zemen Bank. So what we are trying to show you is the corporates. So some of these metrics, by the time we see in the banking, is different. As some of the things we look at are different. We don't look at profitability in the banks. We look at the asset quality. We look at the earnings power. So I'm just saying we use what we call the Camel's approach. This is for corporates. So, but the banks are an interested party in it because they need to know what their corporates are doing so they can grant credits to them. But those are questions very valid. I will not give an opinion now until we get to the banking so that I don't preempt the MPL issues that exist. Let's take it in Swahili, we say kidogo. Let's take it slowly and we get there. But are there other questions? I think I saw one hand up there at one point. Okay, they've stepped down their hands. Fantastic. I guess we can move. What are we trying to achieve with this? We want to turn you into a rating analyst, a quasi-rating analyst. We say these are the parameters we look at, and we're giving you what is the strongest, what is the weakest. In between has so many other things in between them. And these ratios, these benchmarks are calibrated periodically and also industry specific. So this is for corporates. That's why, I can't answer questions on banking on this. When we get to the banking, we'll answer questions. So now let's move to beyond profitability. Let's look at the next, which is cash flow. Why are we doing this? We wanted to just show you that there are different metrics under each of those segments. Under each of them, cash flow, obviously we'll look at EBITDA margin, the earnings before interest, tax, depreciation, amortization, vis-a-vis your total revenue. Why is this margin important? We want to be sure how much you have kept back after you've paid all of those issues. Depreciation from an accounting perspective is a non-cash, and therefore you need to do what? Add back. It feels like I'm going to an accounting class right now, talking about all of this depreciation and amortization. But these are the things we look at. Depreciation and amortization, you add them back because they are non-cash items. They are just book entries. What are the cash items you need to go out from? Your interest, your taxes, then you add back that. That shows us some position of what your potential cash is. And then we'll now look at strongest. If your EBITDA margins are above 20%, you're doing very well. If your EBITDA margins are below 5%, you're weak. Meaning above 20%, you're on the triple A. Below 5%, you're on the D. Everybody else between double A and C, which is the gradings, are in between. We look at operating cash flow to sales. What are we trying to measure here? We want to measure how much of our 1 unit of sales is kept as cash in an operating standpoint. I sell 100 units. How much of that do I keep as operating cash in the business? Critical tool. And we also put a benchmark of 20% to say if for every 100 units or 100 Ethiopian birr, you keep 20% as operating cash, meaning I have paid off my expenses and I have 20% left, you are doing very well. The gold standard is 20% minimum. If you go below 20%, we say you are becoming weak. And you go below 5%, it means for every 100 birr item I sell, I'm only able to keep cash of 5%, meaning I've used 95% of it as cost. That's the flip side of it. Whatever is not part of the operating cash is a cost to that, is the flip side of it. So I'm just trying to put us in because these are getting technical but I mean, please just follow me. We're getting somewhere. The next metrics is on leverage. Let's just talk through these metrics. On liquidity, we'll talk about leverage. Liquidity has to do for a corporate entity, liquid resources. Are they expected to hold a lot of liquid resources? Yes and no. Because they could have liabilities that they need to meet. And therefore, we look at your liquid resources vis-a-vis your assets. What's the proportion of your liquid to your assets? The more liquid you have, the more you're able to meet your obligations. If you are to be a bank, we'll not advise you to be this liquid, which is why the banks have a statutory liquidity ratio. In Ethiopia, I think it's 20%, no, 25% in Ethiopia, if I'm correct. The liquidity ratio in Ethiopia is 25%, or I think it's 20 or 25%. Sorry, who knows the liquidity ratio? 15. Oh, that's true. I thought it was 20 or 25, but we'll check that. So the idea is that for a corporate entity, you can hold more. But for a bank, you shouldn't hold more, otherwise that means you're not doing business. Because your business is intermediation, granting out credits. So you shouldn't hold more. But the converse is the case for a corporate. You should have more to continue to supply, continue to meet your supply obligations, and you see the metrics is different. So when you look at this in the banking, the ratios will be slightly different. You go to liquid assets to your obligations. Vis-a-vis obligations, how many times can you cover your obligations? And obligations here will mean your short-term obligations that are due. We don't mean your entirety of your obligations, because the risk assessment will be done annually. So therefore, we need to measure, can you meet your next obligation, milestone obligation, over the next 1 year? We're not expecting, we're not thinking about the 5 years, we're thinking about the next 1 year, because we'll come back and do another review to measure your current position of liquid assets. And that's how these metrics are developed, such that if you're able to cover your short-term obligations 1.5 times, it means you are strong. If you're not able to cover it, you're at 0, meaning you don't have liquid assets to cover your short-term obligations, then it's a worrying signal for that particular entity. We move swiftly into leverage. Leverage has to do with debt. And when you're measuring debt, one of the things you want to look at is what proportion of your assets is financed with debt. Debt is risky because it has cost. I mean, one of my tests I did then was on debt and equity, which is better, which is more cost, which is more cheaper. It's a very topical issue in finance, and there are various schools of thought on, is debt cheaper than equity, or is equity cheaper than debt? And we'll not get into those conversations. But the question here is, how much of your business is financed through debt? And what type of debt is it financed with? Commercial debt, concessionary debt, non-interest debt? The higher your propensity to interest-bearing debt, the riskier the business is. Let me put it again. The higher your propensity to interest-bearing debt, the riskier your business is. So if you're financing your business purely on commercial interest-bearing debt, it's a risky, because if those debt holders request for their financing back, how would you be able to pay? And they all have costs. And it's only a creditor that can take you to the courts. A shareholder or an equity holder cannot take you to courts to reclaim or repossess your assets, because an equity holder is taking all the risk, both the profit and the losses in that particular business. But a debt holder is not a shareholder. He has given you financing and needs to be paid with interest, which is why the reward for debt is interest. The reward for equity is dividend. Dividend not paid does not cause problem. Interest not paid can create problem. And I'm sure we've seen the case of Ethiopia as a country itself, the recent milestone payment that we missed for our obligation. It's an issue, global issue. I mean, it is an issue because it creates a perception in the minds of people that perhaps Ethiopia does not have the capacity to meet. Or if it's not a capacity problem, is it a willingness problem? Big issues. I'm not going to dive into those. Tomorrow we'll talk about it, but that's how the more debt you have, the more risky, and not just debt, the type of debt that you have. Because you can have what they call concessionary debt, you can have what they call patient debt, you can have what they call non-interest bearing debt. And those ones are not risky. So our proportion here is on the interest bearing debt. And we're saying if you're financing your business with 75% of interest bearing debt, then you are creating a lot of risk into that scenario, into that financing structure. You also have your interest expense to sales. I'll come to you, Fasil. I know you want to come back to me. I don't. Just give me. Let me end on this slide because post this would go into the banking space. Interest expense to sales. How much are you paying? Some people call it debt servicing. The debt service cost. Vis-a-vis your revenue. How much are you using to settle your interest? Not even the principal. And we've said if you are doing more than 5%, it's a worrying signal. So the question is this realistic for all types of businesses? No. Corporates, it may make sense. Banks will be different. Governments will be different. Some governments use 40-60% of their current revenues to settle debt. And that will impact on perception and on the risk of that business. But I think from a corporate standpoint, our sweet spot is 5%. Interest, not principal. Interest, not principal. I wanted to clarify interest, not principal. Principal can be structured as bullet repayment or amortizing, but interest. If you're using more than 5% of your income to repay your interest, and this can also be applicable into our own everyday life as individuals. We're not saying the total borrowings you are repaying back, we're saying the interest portion of it. If it's more than 5%, then you should start thinking about maybe it's too expensive. Can we look for cheaper options? The debt service cost ordinarily they would say typically should not be more than 30%, both your principal and interest, because it is also be bigger than the interest. So meaning 5% for the interest, 25% for the principal. A rule of thumb, 30% debt service should be good enough. Beyond that, it's impeding on your income. These are just contexts that we need to put, but this is the rationale behind metrics, parameters, bands, and as I mentioned, all of these changes with industries, with new information, with research, and therefore they keep getting recalibrated. At least a minimum of 2 years, 3 years, these benchmarks will change. And these benchmarks can also be industry specific. So let me take a pause here because the next we'll be doing will be on the banking. Take your general reflections, questions, comments, then we'll dive into banking.
I think I'm the only cop who can pull him over while he's speeding on a freeway. And even then, he sort of admonished me from pulling him over. Interesting part is I haven't seen any exhaustion, wanting for a health break. Sounds like very engaged and interested audience. I am personally very engaged. I'm not even feeling tired. I usually doze off this afternoon. This time around, I'm as energetic as I've ever been. Do you feel like you want to take a health break right now? Or should we first take questions and then put it forward to EK to get some of his reflections? Let's open it for questions. Let's do a couple of questions and we'll take a health break.
Yes, sir. Please go ahead.
All right, I have a couple of interrelated questions. So first, who sets these parameters for credit rating purposes? Are there a set of applicable standards written, or is it rule of thumb, or is it firm specific? And in the meantime, do you have professional bodies for credit ratings? And also, how do we compare ratings of corporates or banks? How do we ensure uniformity within all this?
Okay, thank you so much, sir. taking your questions. Do we have more? So that I just put them all together. Perhaps there's also an overlap I can just share. This side of our room, that far end towards the northeast. Can we get your voices and your questions?
If
Well,
no
not
one
saying you
is,
are from geographically that location, but just saying that's where you're sitting position from where I stand.
So if no one is asking a question, I'm going to ask a question as a participant now.
Okay, sure.
Taking off my hat off
Okay.
from the emceeing and a participant. We have an experience of real estate companies taking advances with a promise to deliver apartments in houses, right? And there's been instances when those promises have not been fulfilled, that they've been taken to court, and essentially, a buyer has been turned into a creditor to a real estate company. You mentioned that, that's pretty much like free money. It's not free at all, and there's some strings attached to it and obligations to fulfill. And failing that could all be added to your leverage of the business, and you could potentially be extremely leveraged because of your collecting advance. It's not unusual. We've heard of quite a few cases in the market.
Okay. Thank you, Fasil, and thank you also for your question. So I'll start with yours in terms of who sets the parameters. Very interesting question. So many things happen to set the parameters. First of all, there is the global standards, which I mentioned, the IOSCO standard, that defines what exactly the rating agency should be doing, what opinions they should be providing, how they should be providing. It's somewhat like a general bespoke methodology, but that bespoke methodology has to now be contextualized into the local context, into what happens. Now, beyond that, the research that you do informs you of what benchmarks are relevant, what benchmarks make sense, what benchmarks are attainable, which is why the one size fits all doesn't work. What works in Asia in terms of the benchmarks cannot be the same thing to work in Ethiopia. It cannot. It cannot. The guidance will be applicable here, but the benchmarks, that means that benchmark will be dependent on research that has been done here. What level of research has been done? Industry, market research to determine, and then you do not also want to put this particular country, this particular nation in a, I'll put it now, in a prejudiced position that they seem to have been favored. So therefore, there are standards, there are rules, there are certain benchmarks that are global also. Let me put it that way. You talk about debt to equity ratio. It's not a country-specific ratio because it's a risk matrix for debt to equity. You talk about your debt to asset ratios. Those are specific, general. You talk about your return on equity. Why you may want to customize your return on equity to the local environment. An investor out there who's taking 35% return on his investment will not want to take lower because he's giving you finance. Rather, you want to take more because you are more riskier than where it's coming from. You begin to see that. So some benchmarks are universal, some benchmarks are country, some benchmarks are industry specific. Your import cover, it's a benchmark, international benchmark set, 3 months minimum. We're not going to change that benchmark to give you 2 months because no. We'd rather ask you to look at your reserve position, your balance of payments, your current account. Are you seeing? So it's a combination of a lot of things. There is guidance also, which is why for a rating agency, you also provide those methodologies and all of that to the regulator who understands and now says, okay, this is how our environment is, this is how our people will be appraised and measured, and therefore on the basis of that, you cannot do comparability. You can compare with the final outcome. So let me explain the final outcome here. When we get to the final outcome, we'll get a rating, a AAA, a AA, a single A. That's when we can compare across industries. Within industry, we can compare the parameters. We can compare one company to another. But outside of the industry, you can't use those parameters to compare. I can't compare Zemen on capital adequacy ratio with its switch on capital adequacy ratio. No. They have some different purposes, they do different type of business. But I can compare the final rating outcome. Assuming Zemen is a AAA, assuming Ipswich is a AA, I can compare that rating because I've calibrated all of those indicators into a final outcome, and then I can compare them. And that's what the investor wants to see. The investor wants to see the final outcome, regardless of what you have done through the methodology, through the process. What is the final outcome? then I can compare where to put my funds to, where to allocate more to because of the risk profile. That's how those parameters are set up. And those parameters are periodically reviewed also. Then you talked about real estate and housing. Because I think I've answered your question, parameters and comparison. Now, in terms of real estate and housing, we think it's free money, spontaneous finance. Even the ones given to you by the creditors are not free. They are free, but it has to be paid back. So what we are saying is that you have good credit quality to be able to attract those kind of credits to run your business, but there's a pay date. And you stand the risk. There's also what they call the moral hazard. They can have too much payables. Because by the time you attract those kind of credits for so long and you're not really paying back, your books get shut up with what they call trade payables, meaning you have a lot of payables, a lot of liabilities to meet. And therefore it becomes another issue entirely on its own. Do you even have capacity to meet? Why we're asking you to attract it, but do you have capacity to meet those obligations? So it's a very interesting dynamic that while you are thinking about spontaneous financing credit, you also think about capacity for a future repayment, especially if you're not trading, if you're not delivering the assets for a real estate company, it puts you in a very wrong and bad place because litigations become the order of the day. And litigation foreclosures would also mean people would actually come and take over your company to run those businesses. And that could become the end result for real estate businesses. So I just thought to put color to that while we continue to march forward. Now let's switch gears. From corporate, let's go into banking. Banks and non-bank.
Should we get a permission from BK to take a health break, or
Yes.
he's not allowing us to?
No, we're here till 7, so we can take a health break.
Do you like? How many of you? Maybe we could just decide by raise of hands. Do you want to take a health break, or you want to keep going? Okay, everybody's quiet. Let's take a health break. 10, 20 minutes, 20 minutes, 10 minutes, and we'll be back. Okay, there's no photo op this time around. It's just a matter of grabbing your coffee, stretching your legs, and coming back.
Okay.
See you all back again. It was a well-deserved health break, which you all refused to take, but we forced you. And thank you for coming back again. Still a good turnout after the tea break. Perhaps I would like to sort of walk you through what our thinking is in terms of covering what is left. I thought I was the only person who's a cop pulling over when it comes to content, but we also have a time cop. My colleague Gosa is telling us that we're not moving fast, and he wants us to cover certain issues real quick. What we'd like to do is go through whatever is left of today's, and what we cannot cover, we'll move it for tomorrow. And by 5 p.m., we'll allow ECMA, Stefanos is here, who will do a presentation of the regulatory framework for a credit rating agency, or what we call a regulation for the capital market service providers, which is one of them, credit rating agencies. And then there's a case study that we have it all printed out that we'd like you to take it home, tinker it, work through it, and then come back tomorrow with your responses for a discussion. We'll start off tomorrow's session with a case study, and then take it off with the rest of the program. Ike?
Thank you all, and I'm quite pleased to see you all back here. I mean, I'm quite pleased to see you all back here, and I don't take it for granted. Thank you for coming back. Thank you for listening also, and I want to encourage you to listen more. We have some more conversations to go, and the ones we can complete today, rest assured tomorrow will continue. The idea was we didn't want to put too much information, and this is already looking too much already. So you can imagine what there is to cover and what we need to do. But I mean, grateful that you're back here. So let's just take it a step further. Before we went for the break, we had conversations around the specific parameters and how do we do for the corporates, which is the industrial and service companies. And we try to explain that from the corporate perspective, the same philosophy applies, which is the macro industry analysis, the industry analysis, then you now go to the company analysis before the scoring and recommendation. And we went through the sub-factors and the factors. Now, that was peculiar to corporates, which is why when he had asked the question around these ratios for banking, I said, no, just hold on, we'll get to the banking. Now, this particular methodology we want to speak about is applicable to banks and then non-bank financial institutions, just like the microfinance. Those who take finance in terms of deposits and then grant credit. So this is mainly suited to them. And this is now where you have the big weights, the commercial banks, as they call them. In some countries, they call them universal banks, or even deposit money-taking institutions where they play. So what do we look at here in terms of the criteria and the parameters? For this particular type of companies or entities, we measure the financial strength of those entities. Financial strength does not mean quantitative alone. It also has qualitative. And we try to break our appraisal into two buckets. One called the quantitative and the other the qualitative. And I'm sure a few of us may have heard about what we call the CAMELS approach. CAMELS approach here means C for capital adequacy, A for asset quality, M for management, E for earnings, L for liquidity. Then you now have S for sustainability. So that is the same approach we'll take here in terms of how do we appraise these entities that are providing financial services. So we have the CAMELS. Quantitative, we'll look at the asset quality, which talks about the loan book, which talks about the NPL ratios, your provisionings. I know we have not adopted Basel II. We are having a modified Basel I. What is the implication for that? How comparable is it to? Because even there's Basel III that is already in place and being enforced. We look at asset quality, look at indicators. How do we measure? We'll now go a step further to look at capital adequacy. Now, capital adequacy is a function of statutory requirements. The National Bank of Ethiopia has certain indicators that the banks need to comply with. Capital adequacy ratios, what are the benchmarks that they need to keep? What is it today? Are there going to be changes to it? We look at leverage ratios. What are those proportions that have been required for us to keep? Perhaps CRR ratios, reserve requirement, all of those issues fall under this assessment. But if you notice, from the banking perspective, most of them are regulatory driven because We are a financial intermediary. We take from what they call the haves and gives to the have-nots. And because of that intermediation role, we have to be checked periodically. And that's why the central bank typically will provide indicators that need to be monitored, and they provide what they call on-site and on-site supervision to ensure that we meet those terms. And where there are challenges, they come in to step into support. Beyond that, we also look at earnings. It's not enough to focus on the regulatory. What about the shareholders? What exactly are our earnings? What are our returns to our shareholders? Now, there's also what we call striking the balance in the financial strength, financial condition. There are three things that always come out, and I think if we were to take anything around banking appraisals, what do we look out for? There's what they call solvency, liquidity, and profitability. Solvency, liquidity, and profitability. Different organizations are structured in such a way that they want to achieve those goals. What is solvency? You want to be solvent such that even if there's a challenge, you're able to still carry on business and meet your obligations. What is liquidity? We need to have liquid assets and liquid resources that we can convert to meet our near-term obligations. And what is profitability? We need to remain profitable to be able to give value to shareholders. So there's always that conflict of which of them is more important than the other. Should we be solvent by keeping a lot of capital? Should we be liquid by keeping a lot of cash? Should we be profitable by making more, by granting more loans at higher cost than what we earn them? So in finance and in the banking balance, there's always the contention between solvency, liquidity, and profitability. Where we expect banks to be and other financial institutions to be is in the sweet spot of being solvent or being liquid enough and being profitable, because one cannot suffer at the expense of the other. And let me give you a case study or an example of it. If, as an institution, you focus on being solvent, you'll not be able to create a lot of loans. And therefore, you may not be able to do what? Meet some of those obligations of your shareholders. If you now focus too much on profitability, which is now you're creating a lot of risk assets, you stand the chance of creating bad risk assets too. Because the more you create those assets, there's a tendency that a number of them may become bad, and therefore it can erode the capital of that particular business. You focus on keeping liquid assets. You're not in the business of keeping liquid assets. You're in the business of creating assets that will catalyze the economy. So at every point in time, you must think about it from a strategic point of view. Where do I want to be? What do I want to achieve from a solvency perspective? Can I comply with all of the statutory requirements, minimum ratio requirements, CRR, liquidity ratio, capital adequacy ratio? Do I have the capital requirements? Today, I understand that the National Bank of Ethiopia has also increased the minimum capital requirement for banks to 5 billion birr. Most banks are struggling to meet that capitalization. A number of banks have already met it. That is on a solvency perspective, because we're talking about capital adequacy. So the idea here is that as a bank, as a financial institution, we need to focus on the three of them equally, without anyone having a higher weight on the other. However, in practice, some banks lean towards one over the other, and that reflects what they call the risk appetite of that particular institution. If you're a bank that is focused on a lot of profit, you will lean more towards profitability, and therefore all of the activities will be geared towards creating risk assets and getting value for it. If you're a bank that is focused on safety, you will lean more towards solvency, because you want to keep those ratios such that in a case of challenges, you're able to. If you're a bank that's focused on meeting your obligations as they come due, because some banks pride themselves in that if you come to our banking house, we'll repay you no matter what, and therefore they will keep a lot of liquid cash. But the ideal scenario is to have the sweet spot between solvency, liquidity, and which is what all of these metrics I'm speaking about is trying to compute. We're trying to ensure that you are liquid, you're solvent, and you're profitable. None should be higher than the other. And that is the quantitative assessment. But underlying that quantitative assessment has a qualitative assessment. Remember, creditworthiness. We need to look at both the quantitative and the qualitative. Under the qualitative, we'll be looking at now risk management. Why is risk management so prominent for banks or for non-banks? Because we are creating risk assets. So credit risk, operation risk, which is operational risk, market risk, governance risk. You need to have a framework that measures all of this risk and reports on this risk, and not just measuring and reporting, providing solutions to those risks. Risk is not static. Risk changes. And therefore, you must be ready. You must have systems in place to monitor, measure, report, and review those risks. And that's one of the qualitative factors we'll be looking at. The next qualitative factor, which is similar to what we looked at in the corporate, is business structure and staffing. How is the business structured? Across departments, geography, by products. Do we have product leads? Do we have regional leads? Do we have branch leads? How is the business structured? The people that are manning those positions, do they have the right skill sets? Are they competent? Do they understand the markets where they're playing in? Traditionally, some banks are focused on some specific segments. Some banks will be focused on private, on the retail, or on the public sector, or even on the corporate names. That's how typically banking industries are. A number of banks will not be focused across, they will not be giving financing to everyone. They will have specific niche. Do we have niche players? If we have niche players, how are they being appraised? How are they set up? What's their competitive advantage? All of this is what we're looking at under business structure and staffing. And finally, we're looking at management. Under management, we look at both the owners, who owns the boards, how are the boards comprised, how are they set up, what is their role, the audit committees, the different committees apart from the audit, what functions do they hold, who sits on those boards, diversity of those boards, excuse me, inclusion as part of those boards, because those are social issues that need to be considered. Then we talk about the management competence. Who is the managing director, the CEO, the president? Do they have vice? Do they have support? Do they have CRO, chief risk officer, chief financial officer? What roles do they play? What skill sets do they have? Are they square pegs in square holes, round pegs in round holes, or square pegs in round holes? Bigger issues that a rating agency must understand and appraise in the course of giving an opinion, because banking industry and the financial services are a very critical component in catalyzing economic development. And I want to repeat it, banks and financial institutions are very critical in every ecosystem, which is why there's a lot of supervision on, because one bank failure, especially from a systemic bank, can run the whole entire system. So what it means is that